Okay, my dear friends, let's start with our next chapter, which is Quality Cost Management. In this, please pay attention. There is Lean Accounting Theory, Six Sigma Theory, Meaning of Quality, and Competitor Environment Theory. Questions related to cost of quality and questions related to TQM are asked. But this chapter has both theory and practical aspects. Alright, so right now we are going to do the practical part. There will be a separate marathon video for the theory part. You can listen to all of that over there. So now let's move on to the practicals. We are dealing with all the practical questions related to quality. For example, here there is a question given on Pareto analysis. Look at this. In your institute's maths, there is a question on Pareto analysis. So, do you know about Pareto analysis? It is an 80-20 analysis, so how do we solve its sums? For example, what is given here? Defect type is given and number of items is given. That is, how many defects occurred, like how many cracks were there, how many improper shapes were there, all that is given. Its frequency is given, and suppose you are asked, out of these, which is the top defect that we need to work on? Alright, so if we have to do 80-20 analysis on this, how do we go about it? Step number 1 is that you arrange everything in descending order. What will you do? Arrange them in descending order. You will arrange them in descending order. So look, this is coming up, this is step 1. 53 will come at the top. Then step number 2 is to convert it into percent of total. Convert its frequency into percent of total. If you take the total here, how much is it coming to? See, if you add 53, 10, 63, plus 8, plus 8, plus 5, it comes to 84. 53, 63 plus 16 plus 5, 84. Alright, so by taking 84 as the total, if you do 53 divided by 84, you'll get a percent, and by doing 84, you get 63.1. In the same way, by dividing 10 by 84, you have to calculate the percent of total. Then in step 3, you have to find the cumulative percent. You have to calculate the cumulative percent of the total. Alright, so in this 63.1, you add 11.9, then add 9.5 to that, then add 9.53, and then add 5.9 to this. In the end, it always comes to 100. Alright, in the end, it always comes to 100. So after all this, you have to select the top 80%. So here, up to 80%, whatever is coming, it's these two. If you see, the third one is crossing 80%. But up to 80%, only these are included. So, the top 80% that you need to work on are surface scratches and cracks. Pareto analysis teaches us that you can't work on everything. If you just work on the top 80%, the job will get done. Alright. That's the end of Pareto. Let's move ahead. Let's move ahead. The sums related to this are given at the end. See here, this question is given here. Zebra Limited introduced a quality improvement program and the following results were observed. So, sales are given, scrap is there, rework is there, and production inspection is there. Product warranty, quality training, and material inspection are also there. You have to classify the quality costs for 2 years and express each class as a percent of sales and compute it. Increase in amount of profit due to quality improvement also needs to be classified. So, as you might remember, scrap is considered internal failure. Rework is also an internal failure. Production inspection is considered appraisal. Product warranty is an external failure, quality training is prevention, and material inspection is appraisal. So, what needs to be done now? Everything has been classified. Now, express each class as a percent of sales. So, for each class, you will have to make a table like this. What is the total cost of internal failure? For example, scrap and rework are there, so it's 150. Alright, and here it is 650 and 550, so this will be 750 and this will be 600. Now, for each class, it is asking for the percent of sales, so if you do 750 by 10,000, you get 0.75%. But actually, by doing 750 by 10,000, it is not 0.75, it is 7.5%. And if you do 600 by 10,000, it is 6%. So, you have to classify it like this. After internal failure, there is external failure cost. What comes under external failure cost? Product warranty. What is its amount? 500 to 50. So, to convert it into percent of sales, if you do 500 by 10,000, it is 5%. If you do to 50 by 10,000, it is 2.5%. Did you understand? In the same way, you can do the appraisal and prevention part by yourself. In appraisal, there is product inspection and material inspection. Then, add up the total and convert it into percent of sales. For prevention, only training is given. For quality training, you just need to write the amount and convert it into a percentage. I will do this part. What needs to be done in part B? You just have to calculate the increase in amount of profit, so basically do sales minus all costs. You know the sales for both years and just subtract all the costs given, the quality costs, subtract all of them. Scrap, rework, that's fine, or you can also subtract the group total as well. How much is the internal failure? What is the total of external failure? What is the total of appraisal? And how much is for prevention? If you subtract all that, you will get the profit, and you have to see and mention how much this profit is increasing. You have to comment on it. It's very easy. Fill it up yourself. It will be done. You'll get the answer. Yes, next is question number 2. This is a slightly better question. If you haven't done this before, you won't be able to solve it. So, what is it saying in this? The company manufactures a single product. Alright, it requires 2 components. They are purchased from X Limited and Y Limited. X Limited has quoted 180 for 100 units, but there, 3% of the total received are found to be defective. Y Limited has quoted a lower price, but there, 5% are found to be defective. If the defective items are not detected and they enter the system, they will cause damage costs, which will be at the rate of 100 per unit. The company wants us to do some inspection at the time of receipt, and the cost of inspection is 24 per 100 units of components. Inspection will be done for all the components that are purchased, that's true. The component will only be able to detect 90% of the defects. No payment will be made for components found to be defective. So, through inspection, only 90% of the defects will be detected. If we don't make payment for those, then the 10% that remain undetected will incur damage costs. The question is asking, please justify inspection at the point of receipt and give your working for the same, assuming a total requirement of 10,000 units. Assert in the lowest supplier. So here, since it is written, assuming total requirement of 10,000 units, you will have to consider that in part A as well. Alright, it's not possible that you don't take anything in part A. You will take 10,000 units in part A and then conclude accordingly. Which is the lowest supplier and is the inspection justified or not? The first paragraph is about no inspection. The second paragraph is about with inspection. If you don't do the inspection, then 3% and 5% defects will be found. You will have to bear the damage cost for that. Alright, and the payment will be made for the entire quantity you purchase, so present it accordingly. We are explaining this to you. Now see, here I have already prepared the solution for question number 2. So that I could be fast with you, so with no inspection, 10,000 units were purchased. Suppose units purchased are 10,000. According to the defect rates of 3% and 5%, that comes to 300 and 500 respectively, so the good units you actually get in hand are 9,700 and 9,500. But you are paying the full purchase cost for all 10,000 units, which is at the rate of 180 rupee per 100 units and 174 rupee per 100 units, since the defective units were not detected. None of this was detected. Since inspection was not done, defects were not detected and they caused damage. The rate is 180 rupee per 100 units, so 180 divided by 100 times 300 was calculated. When 180 divided by 100 was multiplied by 500, the defective cost was calculated, so the total cost was obtained. Then, from this total cost, we calculated the average cost per good unit. This divided by this, in the question for 200, it is per 100 units, so we took per 100 units, and the answer comes to 191.13 and 192.63. Now, if inspection is to be done, then the working has been carried out for inspection. We will purchase 10,000 units. Out of those, the defects that are detected will be returned. So, how many defects will be detected? of the total defects, 90% will be detected. So, taking 90% of 300 and 500, we get 270 and 450 respectively. So, if we subtract this, the units paid for come to 9,730 and 9,550. Payment has to be made only for this much. The ones that are detected will be returned, and then whatever remains undetected will cause damage. So 30 and 50 remain detected. Those will cause damage, so our good units are calculated accordingly. Now, the purchase cost will be calculated only for 9,730 and 9,550. Because you have returned them, and the damage cost for the defective ones will only be charged for the units that were not detected. So, at the rate of 180 per 100 units, at the rate of 180 per 100 units, right? So, it comes to 54,090 and inspection will be done for all the units. Inspection for 10,000 units will be done for the entire 10,000 units. Alright, so the rate was 24 rupee per 100 units, so it comes to 2,424. So, this gives us the total cost. Now, you calculate the good units at the average cost. To make these two costs comparable, calculate the average cost per good unit. If you see, the good units are 9,700 or 9,500, so accordingly, the average cost per good unit is calculated. When you look at the Institute's solution, the answer doesn't match. Because there, the average cost is being calculated per units paid for, not per good unit. Alright, so according to me, this is not logical. There was a similar question in the Institute's mock as well. In that, the Institute has shown the calculation as per good units. So now, by comparing both of these, it is clear that according to 191 and 192 and this 205, 201, inspection is not justified because it is increasing the cost. Alright, and if inspection is not justified, then which supplier will be selected? Between X Limited and Y Limited, which one is cheaper? X Limited. X Limited is cheaper, alright, without inspection. So it should be selected. This is what you have to conclude. Did you understand? I will also go a bit fast. But are you speaking right now? Understood. But until you try doing this once without looking, you won't be able to do it. I can say that with a guarantee. Just try doing this once. Now, once this chapter is finished with me, move on to question number 3, learn that as well, see what it says. There is a bit of a twist and turn in that too. If you haven't done it, you won't understand it. For example, it says that a company manufactures sports shoes in India. Its main customers are sports clubs and their members. Some finished products have rectifiable defects. This problem can be detected and rectified during internal inspection. Some rectifiable defects occur which we can fix. The inspection cost is 30 rupee per unit and the rectification cost is 18 rupee per unit, which we managed to fix. We rectify the defects. During 2022, 60,000 pairs of shoes were manufactured and sold. After inspection, defects were detected in 5% of the output after sales. Customers reported defects in 5% of the output. These shoes were received back from the customers and the transportation cost per pair was incurred. Due to the negative publicity arising from the sale of defective material, loss in sales is expected next year. Here, the word next year is important to the extent of 5% of external failure. Analyze the cost of quality, showing its elements separately with workings. And the second question. If the price per pair of shoes is 600 and the variable cost is 60%, fixed cost is 550. Prepare a profitability statement for the product during 2022. So first, the cost of quality. If we look at it, firstly, the inspection cost is shown as 30 rupees, secondly, the rework cost is shown as 18 rupees each, and thirdly, the return transportation cost, which is 10 rupees per pair for the ones we receive back. That cost is included. Alright, so these three costs are what we see as the cost of quality. If we classify them, then inspection is the appraisal cost, rework is the internal failure cost, and returns are the external failure cost. So now we know the rates 30, 18, and 10, but how do we get the units? For that, a working note for the units has been prepared. The question says that 60,000 units have been manufactured and sold, so 60,000 sold means this is the final output. Now after that, it says that out of what we sold, the customer reported 6% as defective. You have been explained the flow from the produced quantity. First we subtract the defects found at the inspection stage, then we subtract the returns that come from the customer, and only then do we get the net output sold. This flow was explained in class by making a schedule. If you are not aware or missed our class, keep this flow in mind. From what is produced, first defects are removed after inspection, then returns are subtracted. Only then do you get the net output sold. So, if the sold quantity is 60,000, then 6% of this is 3,600. So by back calculation, it comes to 66,600. Then it is mentioned that 5% of your output is defective. So 5% of 60,000 is 3,000. So this becomes 66,600. I understood it as this much was produced. Now, there are a lot of assumptions in this. Now, it is possible that in the institute solution, the 60,000 could also be considered as the upper value. I thought that since it is written as produced, manufactured, and sold, that's why 60,000 is mentioned here, okay. If sold was not written and only manufactured was mentioned, then I would have considered 60,000 as the upper value, and by back calculating from this, I would have arrived at the total quantity produced. Alright, now what did I do with this? The total quantity produced will undergo inspection, so the inspection cost will be 30 multiplied by 66,600, which comes to 19,98,000. The rework will be for 3,000 units, because only the defective ones will be reworked, and the returns will be for 3,600 units, so that will be 10 multiplied by 3,600. So, this is how the answer comes out. Alright, so part A ends here. This is part A, and in part B, it is asked to show the profit calculation. So, in part B, we are doing the working here. In this, sales are 600, 60% is variable cost, so 40% is contribution, and 40% of 60,000, that is, if you do to 40 asterisk 60, 000, then the contribution comes. After deducting the fixed cost, it comes to 5.5 lakhs. The fixed cost comes to 5.5 lakhs. Alright, now after this, as per the calculation, the quality control cost should be subtracted. The costs that are related to quality, like inspection, rework, and returns. So if we are including the cost of rework and returns here, then the profit answer is not matching. But when we are including only the inspection cost in our quality control cost, then the answer is matching. So, if you want the answer to match the one given below, then you will have to include only inspection. But if you want to go strictly by the rules, then you will have to include both. So, we can assume that these two, that is, 18 rupee per minute and 10 rupee per unit, might be included under variable cost, but we are not able to figure that out. It is possible that if there are returns, they have been subtracted from sales returns, and this rework of 18 rupees has been added to the variable cost, so we don't know. According to me, if I were solving the sum myself, I would subtract rework and returns along with inspection. So, in IKE, they have assumed this and perhaps included it in the variable cost. That's why in their answer, they haven't subtracted it, and no details have been given either, so we are unable to figure it out. Alright, and in quality cost, they are only considering 1998. They are not considering these two as part of the quality cost at all. If you look below in the answer, even in the quality cost, they are only taking 1998, so according to this, they are not considering rework and return as costs. But according to us, both of these should also be part of the cost and both should be subtracted from here. So, what should we do in the exam? Long live the institute. Just do whatever the institute is doing. Right now, that's the only way we can suggest to you. Otherwise, if I were in your place, I wouldn't be chanting, "Long live the institute." I would say, brother, do what is right. Even if you give me 2 marks less, it makes no difference to you. That's your problem. I will do only what is right. That's my principle in life as well. Even if I suffer a loss because of it, I will still do what is right. I will not do what is wrong, even a little. So, if you want to follow my principles, maybe some head examiner will come to his senses. He might say, no, what was done wrong by the institute, so do what is right. So according to this, both of these should also be less, and in quality cost, the total of all three should come. Alright, that's what I think. I've presented both views to you. Now you have to make your own decision. Toss a coin, and whichever side you feel more inclined towards, go with that. If you want more marks, then do as the institute is saying. But there is no guarantee that they will definitely give you full marks for that. Alright, and even if you do what is correct, there is no guarantee that the institute will ignore its own solution and mark the correct one as correct. So, it's a 50-50 chance. Anyway, I hope at least you have understood what's going on, right? So with this, the discussion on quality control cost is over. Once you finish the theory, why should you attempt all its MCQs? If you skip the MCQs, you won't manage in the exam. Go through the MCQs 2 or 3 times because you can easily score marks in these short MCQs. Since there are 30 marks of MCQs, you shouldn't risk skipping them. Alright then. Okay, now we are on the favorite chapter of all the students, yes, variant analysis. There has been a demand for a long time about what will happen with this chapter. Everyone kept asking when this will be taught, so here you go, your favorite chapter is here. Now what more do you want apart from this, right? This chapter is known by many names. This chapter is always on the lips of the students. I mean, you can understand how much the students love this chapter. Anyway, let's move on. So let's see from example number 1. See here, what it is saying is combination of variance demonstrated by means of illustrative data, monthly data of production and cost detailing. The standard and actual furniture follows standard and actual. If it is giving you the working days, then it is giving the production, sales price, material quantity and rate as well. The number of workers is given and from that, man days are calculated. From man days, the wage rate per man day is given and then the power consumption is given in kilowatts. The number of hours is given and the rate per kilowatt in rupees is also provided. Power will be treated under variable overheads. Alright, then fuel will also be considered as a variable overhead, so its quantity and rate are also given. The rate is given in rupees per metric ton, so this too is a variable overhead. With respect to output, wire clothing is also a variable overhead. Since it is mentioned as per metric ton of output, it varies according to the output. The variable overheads above have their own input given, but this one does not, so it will vary with the output. This is also a variable overhead with respect to output, and the rest are fixed expenses for which the total has been given. Alright, so to calculate the variance, you have to prepare a normal cost card or a sales card. But if you don't want to make the card, you can also use the direct formula. So, like this one is the sales variant in which standard revenue minus actual revenue has been taken. But our formula says actual revenue minus budgeted revenue. So if you see here how it has been brought, it's simple. Here budget and actual are given, so their quantities are different. The quantity for actual is different, so this will be treated like the budget. Even if standard is written, you will subtract this total sales from this and you will get the answer. According to the rule, we do actual minus budget, and if the answer is positive, it is favorable. For example, if you see you are doing 1040,000, so it comes to 424 lakh, and here if you do 1025 into 40,250, it comes to 412.5625. If you subtract this from 424, that is 424 minus 412.5625, then this extra is coming, right? So, the favorite is coming as 11.75. This is favorable, so we write favorable here. People often write the formula the other way round. Then, if you know the sales quantity for this sales, you can also break it down and calculate the sales quantity variance or sales price variance. So, the preferred way is to make a sales card, and if you work using that, it will feel much easier to you, just like we used to do in our class, right? Budget and actual output, rate and amount. If you write it like this, it will feel much easier to you. In actuals, it is 1060. Yes, the quantity is 1060 tons. The rate is 40,000 and here it comes to 424 lakhs. And what will happen here? 1025, 40,250 and it will be 412.56. Alright, so from these two, answer A will come. Done. Next, we have to do the material part as well. So how will we do the material part? You will have to prepare another cost card because here the actual quantity is 1060. So the material details that have been given are for 1250 and 1025. But for 1060, we will have to calculate it ourselves. Alright, so if I make a cost card here for you, in which there will be standard cost, actual output and actual cost, then for material, see 1250 is for 1025 units. So what will it be for 1060 units? 1250 divided by 1025 multiplied by 1060. So, quantity, rate, amount, how much will this be? By doing 1250 divided by 1025 into 1060, see, it comes to 1293 and this is the material rate. Then, by multiplying by 20,000, the amount will come and for the actual, the quantity, rate and amount will be copied as 128, 20, 250 and the amount will come. So now, calculating the variance becomes easy. Once the card is made, then it becomes easy. But what has been done here is not correct. What has been done here? Look, they've taken the difference between 1250 and 1285, but that's not right, is it? How can you take the difference between 1250 and 85? This 1250, assume that it is for your actual quantity, then it doesn't match because you are running the standard for 1025 and actual for 1060, so this will be zoomed in. That for 1250 to 1025 and for 1060, a new one should be calculated. Now it hasn't been done yet. Ignore what's been explained from any angle, just stick to what's correct. I have told you the slip. It will be the same for labor as well. If man days are 2400, then for 1025 it's this much. So what will it be for 1060? Work it out yourself, take 2400 and use the calculator. You don't have to write it down. Just take the calculator and work it out. So here it comes to 2482 and here the rate is 700, so you'll get the amount from that, and here it's 2320, the rate is 725, so you'll get the amount. After labor, it's power. For power, the 650 process will be used. It should be 6025, 1060, like this, 6025, 1060, or it's coming to 6702.19. And here, the rate is 7.10, so the amount will come accordingly. Then, by doing 6410, you'll get the amount. So after power, I'm not doing fuel. That you can do on your own. In chemical consumption, the thing here is that it is given only in rupees per metric ton, so only the rate is given. For the rate, we will do standard cost and actual output minus actual cost directly. In this, we will not take quantity and rate. We'll not take variance. So, standard cost and actual output minus actual cost. How will the standard cost and actual output be 1800 and actual output is 1060 to 1750? This is the actual rate, so into actual output actual. Our output is 1060. In this way, this will be considered as variable overhead varying with output because the quantity is not given here, so we will assume it varies with output just like it was with chemicals, similarly for your wire. Clothing and packing material will also be done in the same way. Alright, this will be done in the same way, so I am not doing it here. You have to do this on your own. You have to do it in the same way, in the same manner. Okay, for fuel also, do it in the same way as power. So, for those which vary with output, what do? We calculate the cost variance. That is the one which varies with output and the quantity of input given, like material and labor. Alright, since the input quantity is given here, it is being done in this way. You have understood the flow now. Those who have attended the classes are able to catch up quickly. Those who haven't but know a little can understand a bit. Now you should try to do this completely on your own. Of course, the answer here will not match. Whatever is given here, according to that, it will not match. Because here, there seems to be a mistake in the working. And as for the fixed overhead, how that will be done is simple. We will write the budget and actual and then do the analysis. First, the budgeted fixed overhead amount here is 42 lakhs. Here, you can see 44 lakhs and the output is shown as 1025 and 1060. So, according to that, you can also calculate your fixed overhead variance. How will the cost variance come? How does the fixed overhead cost variance come? 42 lakhs divided by 1025 into 1060, standard cost and actual output minus actual cost, 44 lakhs minus actual cost, 44 lakhs. Is it okay? So, after the cost variance, we have the expenditure variance. So, 42 lakhs minus 44 lakhs, then comes the volume variance. This 1060 minus 1025 into 42 lakhs by 1025. It's okay. I have explained the formula. You can calculate the answer again and you should try the rest yourself. Write it neatly in your notebook. Now let's move on to great example 2. Here, there is a point called investigation of variance, which is talking about like when a variance comes as adverse or favorable, you have to look into why it happened. So the answer is you have to look into both. You have to look into both adverse and favorable variances. The answer is you should investigate only if it is material. Suppose you set a limit that if it exceeds 5% of the budgeted cost, only then you will investigate further. So a materiality rule is made like this. A trend rule is made, meaning if you see that the variance is continuously increasing as per the trend, then it becomes necessary to check it. Alright. So, what does trend mean? For example, as given here, if the efficiency variance is 1000 rupees adverse in a particular month, if it suddenly appears in a particular month, then it definitely needs to be checked. But if 1000 rupees adverse is coming every month, then it seems fine, 1000 rupees is coming regularly. If it comes every month, then it is following a trend. So, what should we say? If it is coming as a trend, meaning it is coming every month, then there is nothing to be done. And trend means it is not coming every month. If it comes suddenly, then it definitely needs to be checked. But again, in the case of trends, you also need to pay attention to this. Suppose in a particular month, production suddenly fell. 100 units in a month. You are at 65 units by month 6. Alright, but still 1000 rupees adverse is showing up. So you will have to check it. So it's not like if 1000 rupees is coming every month, you don't need to check. If production has decreased and still 1000 rupees is coming, then you have to check. Everything is going on normally. If 1000 rupees is coming, then it's fine, and if 1000 rupees never comes, that's also fine. but if suddenly 1,000 rupees comes, then you have to check. So, this is what trend means. Okay. Controllability means if there is any variance where we can do something, only then we should take action on it. For example, if the entire material price variance is happening due to foreign exchange fluctuations and we can't do anything about it. Although, you can do things like hedging, which you will learn in SFM. Suppose we really can't do anything. If the economic situation is such that even hedging is not possible, then you need to understand that you don't have to take any action. Sometimes, there is interdependency in variances. If one variance occurs, it will also bring along another variance. For example, if the material price variance is adverse, okay. What does that mean? If we bring in more expensive material, then it is possible that the efficiency variance may become favorable or the opposite may happen. If the material price variance is favorable, then the efficiency variance may turn out to be adverse, because if the material is of poor quality, it will affect labor efficiency. So if something like this happens, you will have to check both. There will be some variances where there is always a possibility of variation, so you can ignore those, and there are some variances which ideally should not show any variation, but if they do, then you will always have to show them. For example, suppose the labor rate has been fixed, then why is there a variance in it? If you are buying material prices from the market and the market is volatile, then if there is variation every time, we won't check the material every time because it keeps happening for us, so just leave it. But if there is a variation in labor, then we will definitely check what the issue is, right? The reliability and accuracy of the figures also warrant your consideration. Sometimes what happens is that your budget itself is incorrect, right? Or there is some mistake while recording the actual cost, so you also have to focus on the reliability and the variance before doing any checking. If the data itself is coming out wrong, then I taught you this point because it can come in the exam. You will have to remember some points about this and also give a bit of explanation. And you know, this question can also be asked in interviews and all. Which variance we should investigate and which we should not. Let's move ahead. There is a sum on this. Okay, there is a sum on cost and benefit analysis of investigation, which is also not given here. Alright. Here, what kind of situation has been created and what details have been included inside, that is not clear. Right now there is no time to read that much. But such sums are made where you have to keep in mind that there is a situation. Suppose here we are thinking whether to investigate, that is, investigate, and the other option will be do not investigate. If you investigate, two scenarios will come up. Either the process will be found to be in control, or the process will be found to be out of control. If it is found to be in control, then assume the cost of investigation is 5,000 rupees. For example, if it is found to be in control, then there is nothing more to be done. If it is found to be out of control, then we will have to incur some cost to repair it. Suppose that cost is 15,000 rupees. And if we do not investigate, then there is no expense here. Now, two things can happen. Is everything in control? If it is in control, then we don't have to do anything. Or, if it is out of control, then what should we do? There is a possibility of incurring a loss of 15,000 rupees. Understood? If the process remains out of control, there is a possibility of a 15,000 rupee loss or an actual loss. You can even assume that the loss could be 30,000 rupees. We have created and given you such data. A similar question has also appeared in 23rd December exam. So, there are two situations, investigate and do not investigate. If you investigate, it will cost 5,000 rupees. If you do not investigate, there will be no expense. If everything remains under control after investigating, then you don't have to incur any further expenses. your 5,000 rupees were lost. But if things go out of control, then you will have to spend another 15,000 rupee to repair the loss and save it. And if you do not investigate and things are under control, then there is no issue at all. But if it remains out of control, then there will be a loss of 30,000 rupees. So now you have to decide whether you want to investigate or not. For that, the probabilities are given here. Suppose the probability of being in control is 90% and the probability of being out of control is 10%. The probability of being in control is 90% and the probability of being out of control is 10%. So how do we decide this? We calculate the expected value of investigation, the expected cost of investigation. How is the expected value of investigation decided? Suppose if you investigate, it costs 5,000 rupees for the investigation, and then if it is found to be in control, after that there is no further expense. But there is a 90% chance that this amount will be spent. So, expected cost means submission PX. So proceed considering 5,000 rupees. You spent 5,000 rupees and found it to be in control. Now imagine such a situation. If you took 5,000 rupees and found everything under control, how much money did you spend from the house? 5,000. So, there is a 90% chance of that scenario happening. Then, if you went with 5,000 rupees and later had to spend another 15,000, then how much does that make in total? 5,000 plus 15,000? If it becomes 20,000, then multiply 20,000.1, 20,000 multiplied 0.1, 2,000 becomes 2,000, so here it is coming to 4,500. And here as well, by doing 2.1, it is coming to 2,000, so your total cost will be 6,500. If you investigate, and if you don't do the investigation, then what will happen? What will be the expected cost of not investigating? What if there are 9 investigations? Here, no cost is incurred at all. Since there is no cost here, it's 0 plus 0, inquiry 9. If it remains in control, and if it goes out of control, then 30,000 times 2.1 will be incurred. 0 plus 3,000 times 2.1, so this comes to 3,000. So, by comparing these two, what do we understand? Since this is lower, you should not go for investigation. Meaning, it's cheaper. It will be. It is cheaper not to investigate. It will be. As regards financial impact, this is considered too. This kind of question comes where without reading the question, you first make this flowchart. This is called a decision tree. So, after making this decision tree, your sum will be solved. Then, there's another question in this, that if we want to find out such a probability, it could be for in control or out of control, anyone can be asked, on which we will do break-even. Meaning, when both are equal, then how will that question be formed? So, assume the probability of in control. Let's call it x. The probability of in control. If you take it as x, then you can call the probability of out of control as 1 minus x, because together both situations add up to 1. Now what do you have to do? You have to equate both. Basically, the question is asking where indifference will occur, where the break-even point will come. Find the break-even probability. Break-even probability is where investigation and non-investigation become equal, so 5,000 into x plus 20,000, combining 15 and 5 to make 20,000 into 1 minus x is equal to. Then what will happen? 0 into 0.9 is 0, so 0 into x plus 30,000 into 1 minus x. If you solve this, you'll get the next value. That's it. You have to conclude the probability for in control and out of control. You have to find 1 minus x. Did you understand? Sometimes such questions are also asked, like whether you should conduct an investigation or not. And secondly, if you have to find the difference or break probability, then what can be done? Where the calculation is balanced, you have to equate both sides. Here, instead of 0.9 and 0.1, x and 1 minus x have been used. Alright, so on top of this, here. Some things have been done, right? Its answer and all has been worked out. If you go into reading so many numbers, you will get confused. I have explained it to you by taking a figure from my side. Next comes, look, planning and operating variance, planning and operating variance. Understand what the concept is. Normally, When we calculate variances, we have an original budget, right? But many times, we are not able to compare the actuals with this budget. Because in actuals, the circumstances have changed so much that the original budget is no longer valid. The original budget might have been continuing for years, but according to the circumstances, we should have revised our original budget. For example, suppose there was a company that used to sell 10,000 units every year, but if COVID comes, and this time you expect that you will still sell 10,000 units, then that's wrong. So if COVID comes, then you realize that even if you manage to sell 8,000 units, that's a lot. You revise your budget and then later compare it with the actuals to see whether you ultimately sold 8,500 or 7,000 or 9,000. So that is the revision of the budget as per the current circumstances, and we call that the revised budget. So, if any value from the original budget gets revised, then the difference between the two, the variance that comes from it, is what we call the planning variance. And the difference between the revised budget and the actuals, we call that the operating variance. And the difference between the original budget and the actuals, we call that the traditional variance. What do we call it? What do we call the traditional variance? Traditional variance is the difference between the original budget and the actuals. We call this traditional variance. Did you understand? Traditional variance is the difference between the original budget and actuals. Planning variance is the difference between the original and revised, and operating variance is the difference between revised and actuals. These variances can be calculated for everything: materials, labor, variable overheads, sales. Wherever applicable, you can calculate it. Just read the question and understand what the original and revised budgets are. When we go to cost variances, there we will take the original standard for actual output. Here, we will take the revised standard for actual output. Keep in mind, you have to take it for actual output, that is, any standard, any budget which is changed for actual output. This can also be called the flexed original budget. If you are using the word flex, it means you have changed it for actual output. We will call this the flexed revised budget. Alright, and it is also known as ex ante and also called ex post. Ex ante budget or ante-standard, ex post budget or ex post standard. So, whatever words are given in the question, you have to go according to that. The details of the actual are just as they are, there is no tampering with them. Now, if we come to the working part here, you can write all this down comfortably later. For now, just listen. What happens is, in the rush to write, you don't listen properly and then you end up creating a lot of trouble for yourself. You should not do that. You should always try to first listen and then you should try to copy down. So, you can copy it down. I am giving you the notes anyway. Okay. So next, we have a question which is example number 2. So what is it here? See, what it says here is roads company manufactures tops which it is estimated require 2 kilograms of X, Y, Z at 100 rupees per kg. In week 21, only 250 tops were produced. So this is the actual output. All the budgeted production was 300. So the original budget was 300. Then what it says is 450 kilograms of X, Y, Z were purchased and used in the week at a total cost of 51,000. So 450 is your actual. Alright. The original budget was for 300. We actually produced 250, for which we used 450 at a cost of 51,000. Later it was found that the standard had failed to allow for a 10% price increase through the material supplier industry. So, this standard failed to allow for a 10% price increase through the industry, meaning this will come in the revised budget. This is your revised budget. So, we create 3 types of levels: original, revised, and actual. So, in the original budget, 300 units are given, and in the actual, 250 units are given. The output has not been revised. Then we take the original standard for actual output. original standard for actual output, then comes revised standard for actual output, and then comes actual. Remember, it is important to take it for actual output. Alright. So it is given to you that it is estimated to require 2 kg of material at 100 rupees per kg. So if you make 250 tops, then it will be 500 here. The rate has been given to you as 100 rupees. In the revised, only the price is being revised. There is no talk of revising the quantity. So this 110 came and here 500 came. 500 has been kept the same. If nothing is mentioned, this stays the same and the new price is written. 450 and 51,000 have been given. So from this the rate comes to 113.33. So now what we have to do is, we have to find the variance. So how will the variance be calculated? For example, if I only have to calculate MCV, then how will the planning variance for MCV come? MCV planning is the difference between these two. You treat this like the standard and treat this like the actual. Treat the revised one as the actual. So that will be 50,000 minus 55,000. 50,000 minus 55,000, that is equal to 5,000 adverse. Then what will be the MCV? MPV planning. MPV planning. How will MPV planning come? 100 minus 110, standard price minus actual price. In actual price, the revised one will be taken into the actual quantity, which is 500. So the answer here is 5,000 adverse. And MUV has not been revised. In planning, MUV has not been revised, so the answer will be nil. Are you able to understand? Now, in this way, MCV operating will come. If we have to calculate MCV operating, it will be the difference between these two, which is equal to 55,000 minus 51,000. That is coming to 4,000 favorable. Then if I have to, not MCV, if I have to calculate MPV operating, what will be the MPV operating? 110 minus 113.33 into 450. See how much it comes to. 110 minus 113.33 into 450. It is coming to 1500 adverse. Since it is coming in minus, so 1500 adverse, and if we calculate MUV operating, just like we do, we just have to compare these two. 500 minus 450 into 110. So, how much is this coming to? 5,500 favorable. See, it matches. But its solution here is written a bit wrong. Because here, the actual result is written correctly, revised flex budget 55,000, that is also written correctly, this is correct, this is correct. Operating variance should be 4,000 favorable, which has been shown as adverse. So, this seems wrong to me. Because the revised budget is 55,000 and the actual is 51, so 4,000 is saved. So this operating variance is wrong. Then in the original flex budget, they have kept it for only 300 units. So that turned out to be a mistake. Flex budget means you had to go as per the actual output, so this too became a mistake, and because of this, the planning variance also turned out to be wrong. That's why I have explained it to you, brother. Now you see what is correct and do it accordingly. Now you might say that the wrong method is the one given in the institute, so that's what the institute. By shouting slogans in favor of the institute, we end up doing the wrong thing. Never. Never make such a mistake. That's it, you understood, my dear ones. We will never make such a mistake. Alright, great. We should always rely on what is correct. If someone else is doing it wrong, what can we do about it? Now, example 3. If you read it once and try it yourself, you will understand what needs to be done here. You should try it once. Then listen to me. Pause the video, try it once, and then listen to me. And the transport company makes a particular journey regularly and has established that the standard fuel cost for each journey is 20 liters of fuel. At 90, so the original standard says that for one journey, you will need 20 liters of fuel at the rate of 90. Due to new legislation, there is a change in the vehicle used for the journey and an unexpected rise in fuel cost. It is decided retrospectively that the standard cost per journey should have been different. See, what is becoming the new standard? For one journey, it should have been 18 liters at the rate of 100 per liter. So, calculate the original and revised flex budget. If the journey is made 120 times in the period, then actually it is saying that 120 journeys have taken place, but for that, the actual details have not been given to you. But it is asking you to prepare the original and revised flex budget. Flex budget means, but the actual output, so for the original, you have to see what the actual output will be. You have to see what the revised budget for the actual output will be. So, if it is 20 for 1, then what will be the actual output, you will understand yourself. Now, it is 20 * 120 at the rate of 90, so the amount A will come, and for the revised actual output, it will be 18 * 120 at the rate of 100, which is 2,16,000. Alright, so in both cases, the answer is coming out to 2,16,000. And here, the solution given is wrong. Okay, there is a mistake in this. If you look at it, you will understand. And alright, you have understood the rate. Let's move ahead now. Look at the next illustration number. I have also done a bit of it for you so that I can explain it to you quickly. If you really want to learn even better, the best thing is to try making the cost card by yourself once without referring to my solution. Those same 3 levels, original, standard revised, and actual. Then here, don't look at anything else, just refer to your institute's material and make the card yourself. After that, it's very easy to calculate the variances on your own. So, what is given here? Look, standard hours per unit of product is given as 1.1 and the rate of labor is given as 18.5. Then, for material, it is given as 1.2 and the rate of material is given as 70. Then, during production, management revised it. They rebudgeted with updated information, so this is your original standard given here. Now, the revised price of material is given. Labor rate revised. Hours per unit revised. Usage of material. This revised standard is given, and then after the production, the company records the following actual results, and here, sir, the actual results are given. Actual production was this much, material used was this much, cost incurred was this much, actual labor cost is given, so this is the actual data. So now what you have to pay attention to is that I have to take the original standard, but how to get the actual output? I have to take the original standard for the actual output. Original standard for actual output, right? So the original standard is saying 1.1. If we look at it for material, it is saying 1.2. So 1.2 into actual output is 15,400. See, what I did here is 1.2 times 15,400 and the original standard rate is 70, so I wrote 70. The amount can be calculated automatically. Similarly, if we look at labor, for labor it's 1.1 times 15,400 and the labor rate is 18.5, so the amount will come accordingly. Then, if we go to the revised standard, for material usage it says 1.175 times 15,400 and the rate has become 71, right? And for labor, it's 1.05 times 15,400 and the rate has changed. It's 20, so the revised standard has come. Are you able to understand how the original standard and revised standard are coming? Just look at these figures and then for the actuals, you just have to copy whatever is given. There's no complication in the actuals, so 16,555 at 72 and 16,632 at 19.5, so this amount will come. Now after this, we will compare these two. When we compare these two for planning variance, we will arrive at the operating variance. So, how do we calculate the planning variance for material? I have shown how to calculate the material planning variance 70-71 star. The value coming here is 1.175 * 15, 401.75 * 15, 480.95, so 18,095. If you want to calculate the Edwards MUV of planning, then how will it be? The difference in quantity between these two, that is 1.2 * 15,400, how much does it come to? How much does 1.2 * 15,400 come to? 18,480, right? And then how much does 1.175 * 15,400 come to? 1.175 * 15,400 comes to 18,095. So 18,480 minus 18,095 times 70. So this comes to 26,950. 18,480 minus 18,095 times 70. You can see how planning variances and operating variances will come. In operating variances, you have to compare revised standard and actual. So if you look at the revised standard, in MPV it's 71 to 72 asterisk 16,555. And in MUV, it's 18,095 to 16,555 asterisk 71. See, it's the difference in quantity at the standard rate. So if you know this concept, you can easily calculate it. After material, now comes labor. You should try on your own to see how LRV and lead are coming in that. Alright, so this way we will get the answers, and here in the answer, there is some adjustment. This is the answer, right? It's not matching exactly. If you look at it, you'll understand what's been done. There's something wrong here. Isn't it? I have seen the summary. There's something wrong. If you look above, you'll understand what's right and what's wrong, and I didn't go into that much detail. I thought, instead of going into depth, it's better if I just look at this much. In this much time, I can finish it. With this in mind, I just worked out the material part here and explained it to you. You have to do the labor part on your own, and normally in your solutions, it shows a total by adding these two together. That total has no significance. There is no point in showing that total. There is no need to add planning and operating together. But did you understand the concept or not? Very good. Finish it now, complete it, pause the video and complete it. If you want to learn, you will have to complete it. If you have just come to watch, then it's okay. This comes under example 3. Here, from this ratio, you have been calculating activity ratio, capacity ratio, efficiency ratio, which I call A's in short. It is also very easy to remember this. If you sleep on the bed, you get comfort, so standard hours for actual output divided by budgeted hours. B for bed, S for sleep. If you sleep on the bed, you get comfort. A wall has been built between capacity A and B. A wall has been built between C actual over and budgeted hours. C efficiency is standard hours for actual output divided by actual hours. First, you should remember the formula, and after that, you also need to keep in mind that A is equal to C into B. You can cross-check this, and after that, you need to see that in note 1, 2, 3, we should calculate this first. What are the standard hours for actual output? What are the budgeted hours in note 2? What are the actual hours in note 3? Find out by reading the question. Alright, so product X takes 5 over 2 to produce, Y takes 10 over, and after that, what is it saying? In a month of 25 days with 8 hours a day, 1000 units of X centimeters of wire were produced. The company employs 50 workers in production and the budgeted hours for the year are 1,02,000, so for actual output. See, the actual output is for the month, so that's 1,600. So 1000 into 5 hours plus 600 into 10 hours, by doing this, the standard hours for actual output are obtained. Budget hours are 1,02,000, so that's for the whole year. By dividing by 12, you get the budget hours for the month. Then, the actual hours that are given, your actual hours are given as per 50 workers working for 25 days. At the rate of 8 hours, so these will be your actual hours. So now, you have got these 3 answers. Put the values above, calculate the percentage, and check whether it matches the C interview or not. If you have never done all this before, then you have to do it now. If you have already done it, then you can leave it here as well. You must have understood the same question will come again later as well, so it's better to try it out here once. Alright, I am moving ahead, reading a bit quickly. You can expect, along with me, that you understand why I am doing this, and if you support me, only then we will be able to move ahead quickly. Alright. Let's move on to illustration number 4. What is this saying? This is making us do a reconciliation here. That's what it's saying. There is a company which has a budgeted sales for a 4-week period. 10,000 units at the rate of 50, and the actual sales are 9,000 at the rate of 51.25. the costs relating to that period are given as follows, both standard and actual. Materials 2.5 lakh standard and 2.57 lakh actual. All these figures given are probably for your 10,000 units budgeted, and this is for the 9,000 units that were actually sold. Then wages are given, followed by fixed overheads, and then variable overheads are provided. After that, semi-variable overheads are given as 27,000 standard and 24,300 actual. Standard hours are coming to 50,000, so we should write those hours here, and actual hours are 40,500, so it seems that these details have been given to us for the respective output. Then what is the question saying? See, the standard material content of each unit is estimated to be 25 kilograms at the rate of rupees per kg. Actual figures are 26 at the rate, so this will help to create the material cost card. That is not here. It is not getting revised. This is a normal sum, so if we do the working for material, for 1 unit it is saying 25 kilograms, so for 9,000 units, how much will it be? 9,000 into 25. We are reducing the rate from 9,000 rupees into 25 and the rate is coming to 225 rupees. At 1 rupee, the actual cost for us is how much for 225? Here it is saying 26 for 9,000, so if we do 9,000 into 26, it comes to 2,34,000, and if we do 1.1 into 1.1, it comes to 257,400. 257,400. Now after material, next is labor. What is it saying about labor? Look, below it is talking about semi-variable overheads again. So since semi-variable overheads are given, there is no separate variance analysis for them. We had learnt one thing, total overhead variance analysis. Actually, total overhead variance analysis is semi-variable overhead analysis. But that should be done only when you don't have a breakup between fixed and variable. So here, the breakup has been given. 5,9 is fixed, 4,9 is variable, so if you put them into these two, then nothing will be left for semi-variable. That will go under variable overheads. Then it is talking about wage rate per unit. Standard wages per unit and 5 hours at 1.5. Alright, if it is 5 hours, then if I multiply 9,000 by 5, it comes to 45,000. So, if we do 45,000 into 1.5, how much does it come to? It comes to 67,500. Then here, it is saying 9,000 into actual hours. We have to take it as 4.5. So 9,000 into 4.5, how much will that be? 9,000 into 4.5 comes to 40,500. And at this rate, if we do into 1.75, it comes to 70,875. After labor, variable overheads. The total amount of variable overheads. First, see, it says 5,9 is fixed and 4,9 is variable, so let's add the 4,9 part in this. Out of 10,000, the 4,9 part of 2,700 comes to 1,200, right? So, we added the 4,9 part of this and also of 2,430. Then, we are assuming that for 9th will remain variable, only then you will be free from total overhead variance, otherwise you will have to do total overhead variance. Alright, so we will do 2,430 into 4 by 9. So here, last 1080 is coming. It means we are assuming that this is the same for both budget and actual. Alright, although it is not written like this in the question. If you assume that it is only for budget and not for actual, then you will have to calculate a different series of variances. Total overhead variances, so the amount of variable overhead here. See, 10,000 plus 1,200 together make 11,200, but 11,200 is the amount for 10,000 units. So what will it be for 9,000 units? By 10 into 9. 11,200 divided by 10 multiplied by 9 comes to 10,080. And similarly, here you have to remember that you don't have to change it. The amount will remain the same. That is 9,250 plus 1,080, making 10,330. That will remain the same. Remember, you don't have to change anything here, and for ours variable overhead, we'll just copy the labor one. 45,000 and 40,500. So its rate will come, so this becomes working note 1. So now you can make note 2. Regarding fixed overhead, check what details have been given for fixed overhead, the budget and actual, and what is the total amount, check that. Total amount in budget and actual, like here in 20,500 you have to add the 5/9 part of 27,100. What will be the 5/9 part of 27,100? If you do 5 by 9, then by adding 1,500 it will become 21,500, and similarly, if you add 5 nines here, it will come to 1,350. So 20,500 plus how much was it? It will become 21,500 here, and 18,810 plus 1,350 will be 20,160. So remember, we do not change anything in fixed overheads. Here, we are writing the budget, that's why we are not writing standard for actual output. And as for the units, that is, we have to take the output. So what is our output? Here, it is 10,000 and 9,000. The output is 10,000 and 9,000. And what are our working hours? What are our working hours? What are the working hours? 50,000 and 40,500. So from this, the capacity efficiency variance will come 50,000 and 40,500. The output is 10,000 and 9,000, and the total amount is 21,500 and 660. Is it okay? Now third, if we also want to work on sales, then we can also make a sales card. In that, budget and actual are included. Budget and actual, so the budget quantity is there. 10,000, the rate was given above as 50 rupees, and for 9,000 at 1.25, it comes to 10,050. This will come to 5,951.25, and here we will calculate the balance. Alright, so in this way, the sales card will be made. What will happen like this? The sales card will be made. Is it okay? Now you can easily withdraw your entire balance. You don't need any help from me in this, isn't it? If you know how to calculate the variance, you can do it easily. MCV will be 225 minus 257, which is 400. MPV will be 1 minus 1.12, which is 234. MUV will be 225 minus 234, which is 1 rupee. The same applies for labor and variable overhead. For fixed overhead, there is some confusion, so I'll explain once. How does the fixed overhead cost variance arise? It's calculated as standard cost for actual output minus actual cost. To get the standard cost for actual output, multiply 21,522 by 9,000. That gives A minus the actual cost, B 660. Then there will be the fixed overhead expenditure variance. In the expenditure variance, what will come is 21,500 minus 20,160. After this, the third one will be the fixed overhead efficiency variance. What is it called? It will be the volume variance. Fixed overhead volume variance, which is 9,000 minus 10,000, which is actual output minus budgeted output into standard fixed overhead per unit, which is 21,500 divided by 10,000. 9,000 minus 10,000, 21,500 divided by 10,000, right. Then, the capacity variance of fixed overhead is, capacity variance is actual hours minus budget, and if you don't remember the formula, then there will be a problem. You will have to first make a list of all the formulas and memorize them. And while solving the sums, you end up memorizing them as well. But if you are thinking that at the last moment you will have to memorize everything, then it is a bit of a challenge, so just do as much as you can. If you can't do it, then leave it. What else can you do? Actual and budget hours into 21,500 divided by budget hours. In volume variance, we divide by output, and in capacity variance, we divide by hours. Then there is the fixed overhead efficiency variance. In the efficiency variance, we will take standard hours for actual output. Standard hours for actual output have also been calculated here, and actual hours are 40,500, so you can take them directly from there. 45,000 minus 40,500 multiply by the rate, which is 21,500 divided by 50,000. So, you can solve this and you will get the answer. The sales variance for fixed overhead is very easy. If you do actual sales minus budgeted sales, then you get the sales value variance. If you do actual price minus standard price multiplied by actual output, then you get the price variance. If you do actual output minus budgeted output multiplied by standard price, then you get the volume variance. So, I have explained everything. Now you have to do it yourself. If you just listen and then forget it, there's no use. If you want, you can stop the video right now and finish this task, then it will be in your hands. Otherwise, if you have already done it and you remember it, then it is a very good thing. Very good. Let's move ahead. After this, what was asked in the question here? It also said to compute sales variance, material, labor, overhead variances. We have done all that. Then there's one more thing. It says, draw a statement to reconcile the actual profit with the standard profit. So look, many students are asking this repeatedly. If it is asked to reconcile actual profit and standard profit, then which method should we use? We will use the normal reconciliation method only. If they ask about the format of the reconciliation statement, how does that work? That works with budgeted profit, which is usually for budgeted output. Alright, after that you add, think about profit volume variances. So after adding profit volume variances, you get a figure. We normally don't do this in class. But still, I am telling you, this is called standard profit for actual output. When the format is written, it is mentioned that this is the standard profit for actual output. Normally, the term standard profit should mean standard profit for actual output. But if you look at the solutions, they are also doing it from the budgeted profit. Ideally, the term standard profit is standard profit, and similarly, standard hours is standard hours. Where standard hours is written, it doesn't mean standard hours for actual output. Since budgeted hours have been calculated, and here standard profit is written, it could mean budgeted profit. But even if you start from here, there is no problem. After this, the sales price variance will come, and then all the cost variances will come one by one, as much as can be broken up. MPV, MUV, and LRBV are also fine. Variable overhead expenditure, variable overhead efficiency, fixed overhead expenditure, and fixed overhead efficiency. I am talking about efficiency. Both capacity and efficiency will come, volume will not come. If the breakup of volume is given, then as much breakup as possible will be included. So, the figure that comes from this will be called the actual profit. So, you have to calculate your answer and check whether you get this or not. Alright sir, you said you are making us revise. Yes, this is revision and you have to put in this much effort even during revision. Just by looking, it doesn't happen. But if you have already done it and you are confident that you can do it, then leave it. If you feel like you are not sure whether you will be able to do it or not, then unless you try, you won't even know. We did not make any working note for the profit volume variant. We did not make any card word above, so what is its formula? A minus BO into standard profit per unit. Alright, so now how will the standard profit per minute come? The budgeted profit that we know is for bow, so you will divide it by the budgeted output. You will get the standard profit per minute. Now the question is, how will this come? For the budgeted profit, you will have to do this working. How? Budgeted sales minus all budgeted costs. So if you look at the data in the question, all of this is budgeted cost. This, even take the semi-variable one. So if you add all of these, you get the budgeted cost. And what is the budgeted sales? 50 x 10,000, that is, from these 5 lakhs, if you subtract all the costs, you will get the budgeted profit. So, budgeted sales minus budgeted cost equals budgeted profit. You will have to take that. First, that budgeted profit will come here, and then you will divide that budgeted profit by the output. From the budgeted output, you will get the standard profit per minute. For the sales price variant, you have made your sales card. We have to take the change in price and multiply it by the actual output. Alright, and I have already explained the cost banner to you. You are taking too much time. Yes, you are taking a lot of time to understand. But anyway, now pause the video and finish this part, then move ahead and give it some time. The questions on standard costing are such that in the exam, they come in a very straightforward manner, while the rest of the questions tend to be a bit tricky. Transfer pricing questions tend to be tricky. But standard costing is very straightforward, so you should make the most of it. It just requires time. It says, give me time and I will give you marks. But if you say you are not willing to give time, then it says, I am not willing to give you marks. Alright, anyway, all these questions are from the intermediate level. But still, I will give you a little idea so that you can crack it. In material variance, this particular sum has mixed percentage given, and here also mixed percentage is given. The quantity has not been mentioned properly. The quantity of material purchased is given, but it is of no use. We just ignore this. You need to understand this particular line here. To make every batch of 100 kilograms, this is the output. 125 kilograms of material are used. This is the input. For 100 kilograms of BXC, 125 kilograms input is required. So, this is the detail of the standard. The standard is that to produce 100 kilograms of output, 125 kilograms of input will be required. Then it says, in April, 60 batches were prepared to produce an output of 5,600 kilograms. So, if the actual output is 5,600, then how much input should be required for 5,600? We have found out 7,000. And 60 batches are prepared, so we put 125 kilograms of material in one batch. If we put 125 kilograms in one batch, then 60 batches were prepared. That means, if you put the actual quantity as per 60 batches into 125, then the total of the actual quantity will be 7,500 and the standard quantity for actual output will be a total of 7,000. So, if you have understood this, then your work is reduced. So, in this, when you have to make the cost card, if we help you with that, then there is standard cost for actual output and then there is actual cost. When there are 3 multiple materials in this, we make one more column. That is the column for SP into AQ. We make 2 columns, SP into AQ and 1 SP into revised standard quantity. These 2 extra columns are made so that our variance can be calculated quickly. Alright, so here we have 3, A, B and C, so the total quantity here will be 7,000. Where is this 7,000 coming from? Think about it, this is coming from note 1 that we made. Now, you have to break it up into 50, 30 and 20%. If you have to break the quantity of 7,000 into 50%, 30% and 20%, then how much will it be? It will be 3,500, 2,100 and 1,400. And what are the rates? They will be 20, 10 and 5. The amount will come by multiplying these 3 and actually, since the quantity is not given, it says 60 batches, so from that, it will be 7,500 by doing 60 into 125. Then, you have to follow the 60, 20, 20 as mentioned in the question. So, 20% means 1,500, another 20% means 1,500 and 60% means 4,500. Then the rates are 21, 60 and 6 and from this also, the amount will be calculated. Now, if you do SP into AQ, you will get the answer. Then, if you do SP into RSQ, you will also get the answer. Now, how will SP into AQ be done? Here is SP, which is the standard price, and here is AQ. You have to multiply these 2 and put the result here. Alright, now SP into RSQ. How do we get RSQ? You must remember, right, how SP into RSQ is calculated. SP into RSQ. How do we get RSQ? We know SP is 20. RSQ is calculated as total actual quantity, which is 7,500 multiplied by the standard proportion. The standard proportion, if you can see, is 50%, or you can also write it as 3,750 divided by 7,500. Similarly, for all 3, it will be 10 into 7,500 into 30%. What happens next? Rupees 10 is the standard price into 7,500 into 20%. So, by taking these three, you will get SP into RSQ. By taking these three, you will get SP into RSQ. Did you understand? So now you just have to calculate the variance. I don't think there's any need to teach how to calculate the variance. You will say, sir, that is what is needed. Array, save some time. MCV is standard cost minus actual cost, the difference between these two. If this is the standard cost and this is the actual cost, then the difference between standard cost and actual cost is the MCV. For the second one, if you have to calculate MPV, and when there are multiple materials in MPV, then you open the bracket SP into AQ. Normally, what happens is, it's SP minus AP into AQ, right? So if we open the bracket now, what will happen? SP AQ, SP into AQ minus AP into AQ. So, the value of the formula SP into AQ will be this total one. This one here, this is SP into AQ. Alright. And AP into AQ means actual cost. So this answer will be AP into AQ, which is the actual cost. So you will have to fit it accordingly. Then, even in MUV, if you open the bracket, I am writing directly. You have to do SQ into SP minus AQ into SP. So, SQ into SP is our standard cost, minus AQ into SP, this column that we just made separately, that will come here. Then, for the fourth one, when you go to material mix variance, it is just a copy of material usage. You just have to put the revised standard quantity, everything else is the same. Instead of SQ, you have to put the revised standard quantity. Everything else is the same. So, RSQ into SP, this one, RSQ into SP, make a separate column for this. So from there, AQ multiplied by SP will come, a separate column is made for that. And if we have to find MYV, then how does MYV come? If you subtract these two, usage and mix, then you will get a formula in which AQ multiplied by SP gets cancelled out. So, if you do SQ multiplied by SP minus RSQ multiplied by SP, you will get answer A. So, SQ multiplied by SP, which is the standard cost, minus RSQ multiplied by SP, for which you will have to calculate the new column values, then you will get answer A. Now you will have to put in the values yourself and check, right? And won't I do everything again and get it completely solved? What an amazing thing you are saying. Now, if you really want to learn on your own, if you have the desire to learn inside you, then be fair and fill it all up yourself. I have explained so much of the framework to you. I mean, if someone comes and tells you all this just before the exam in the exam hall, and even then you don't pass, then how will it work? Alright, so I explained this because even the bracket opening technique ends here. When there are multiple materials or multiple types of labor, how you open the brackets and solve the sum. Alright. Next, look at this sum here. This is your stock related sum. So, what is there in this? The material is being mixed in a 70-30% ratio. The price is given, the loss is given. When the loss is given, we assume it accordingly. For total standard input, like C and Z, here we will consider the total input as 100. If we have taken it as 100, then here we have to consider it in tons. Because it is given in tons, so this will be 70 tons. This will be 30 tons and the rate will be 2400, this will be 650, and here it is saying there will be a 5% loss. Alright, so if there is a 5% loss, then it will come to 95. So, for 95 tons, you can say this. This is our standard. This is the treatment for loss that you have to do your work out here by lying down. Then what is actually given? If you read below, you will understand. Actually, the opening stock, closing stock, and purchases of materials C and Z are given. It is also mentioned how much material has been melted. The casting produced is given. So in actuality, the produced amount means this is the output, 375 tons of finished goods. And for this, how much copper is being used? If you look at the opening stock, it is 100. The purchased quantity is 300 tons, right? You will get its rate. If you do 73,500 divided by 300, you will get answer A, which is coming to 2,441.37. Then, the closing stock is given. How much of it is given? C, then for C, it is given as 110, so from this, the consumed amount for A will be calculated. Consumed A is 290 tons. Now, for zinc also, there will be an opening stock. The opening stock of zinc will be 60 tons. Purchases will be 100 tons at the rate of 625. What will be the closing stock? The closing stock amount? 50 tons, so this is coming as 160 minus 150, which is 110 tons, right? So, this 110 tons has gone to A. Now, this has actually become yours. Now, you have to prepare your cost card. So, the thing with the cost card is that here we have to make an assumption because the value of the closing stock is not given. So, at what rate the value of the closing stock will be taken, we will have to make an assumption about that. Alright, now in this, if we take the closing stock at the actual rate, then it is called the partial plan. If we take the closing stock at the standard rate, then it is called the single plan. Okay, so let's see how all this has been done. Here, if you look at the solution, the closing stock has been taken at the standard price. There should be a line like this in the question, so it means that the single plan is being followed here, and if the single plan is followed, then the material price variance will be calculated on the purchase quantity. The material price variance will be calculated on the purchase quantity. It's not clear how it has been done here, but we'll have to check how it has been done. To see how it has been done, you have to find the data on material purchase quantity, so for this also, you'll have to prepare a cost card and check. First, yes, we'll have to prepare a cost card, so that will be standard cost for actual output and actual cost. Then, extra columns are also needed because there are two materials here, so we'll have to include SP to Q and SP to RSQB. So, in copper, why am I saying copper? It's C. In C, for 95 it's 70, so for 375, what will it be? Do it yourself, calculate it on the calculator. 70 by 95 into 375, so when you do 375 into 70 by 95, you get to 76.3132. The institute has rounded this off to 280. Brother, if you want the institute's answer, you can take 280, otherwise you can take to 76.32. Then what will happen in zinc? Alright, let's finish copper first. After this, what is being said here is that the rate is 2400, so if you multiply to 76.32 by 2400, you get 663168. And what will happen in the actual case? What will happen in the actual cost? Tell me, what will be done in the actual cost? In actual cost, the opening stock is 100, purchases are 300, and closing stock is 110. So, the rate for this 100 will be calculated at 2400. The rate for opening stock will be taken at the standard rate only. And the rate for purchases, the new one given is 22,441.67, and for closing stock, we are taking 2400 rupees. Assuming a single plan, since it is a single plan, the closing stock is coming at the standard rate, and if you calculate the amount, it will come to 240. This one was already 730 to 500, and this is 264. Sir, how are you doing it so fast? You are doing it by looking here, and from this, the consumed amount will come. This is coming to 290, and here it will be 240 plus 730 to 500 minus 264, which comes to 708,500. Sir, let's check that as well. You could have seen it from above, but just checked once to make sure it's correct or not. Now, you have to do the same for zinc on your own. Zinc means said copper and zinc actually. That's why I remembered that in our math, it has been done according to copper and zinc, so you have to do this on your own. Everything is fine. I am not doing this part. You have to do it following the same pattern. It would be better if you pause the video once and try to present the entire Zn part like this on your own and then continue further. Alright, so I have already done the next part. For you, this is the answer for Zn. If you match this, your answer will tally, and based on this, I have also calculated the variance here, which I will quickly explain to you.
As you can see, the material cost variance will come from subtracting the total of these two from the total of these two. MPV for C and ZN should be calculated separately. Keep in mind, there is some smartness involved in calculating them separately here.
There is no smartness in doing it from the combined column. So when you calculate MPV for C and ZN separately, since a single plan is being followed here, you have to do that on the basis of quantity purchased. So in MPV, you have to look at the quantities of 300 and 100, not the quantity consumed. Whereas when you calculate MUV, it will be based on the quantity consumed. And then, when you calculate mix and yield variances, you will use the consumed quantities, that is, you will use 290 and 110. If you have to calculate RSQ, you will apply it on 400. The total actual quantity is 400, so you will apply the standard proportion on 400, which is 70, 30. You will apply the standard proportion of 70, 30 on 400, you will get RSQ. It's better if you do it separately. It's better if you do copper and zinc separately here, because if you make a cost card and do it, it might get a bit complicated. If you make columns and do it that way, it can get even more lengthy. Anyway, it won't make much of a difference. Since there are only two materials, it's quicker to do them separately, so you fill this in. You can also copy it by looking at this, but calculate its answer and see whether it matches or not. Due to some rounding off issues, it might not match exactly with the institute's answer. Here we have taken 270 x 0.32 and 118 x 0.42. The institute took 280 and 120 instead, but you can cross-check this. MPV, MUV and MCV will all come, and MMBV, MUV will also come. So, how will RSQ come? I have already explained. You have to take the total actual quantity in 1730 in standard proportion, and how will you get the total actual quantity? On 400, the consumed quantity, these three will be on consumed quantity. Alright, they will be based on consumption, only MPV is purchase based. Actual quantity purchased, this is the effect of the single plan. Now, if you give the next question, then come to illustration number 7. So, illustration 7 is talking about this. Illustration 7 is talking about something which, as you can see, is about material variance. There are three materials, but it is about tiles. For tiles, length, breadth and height are given. 12 inches, 8 inches and half an inch are given here. 12 inches, 8 inches and half an inch. And the company should produce 12,000 square feet of tiles of 1 by 2 inch thickness. This means that the input data is for 12,000 square feet of tiles and the actual output given is 1 lakh tiles. So, if the actual output is 1 lakh tiles and here it is in square feet, then this is not matching. By saying this, you get the actual output. The output that is given in tiles, you should follow that and also convert the standard output into tiles. So, if we look at our actual output, it is 1 lakh tiles and in the standard, it is 12,000 square feet of tiles. So, we want to convert 12,000 square feet of tiles into the number of tiles. How will he do it? From 12 by 8 inches, we can find out the length, breadth and thickness. So, when we have the length, breadth and thickness, by multiplying length and breadth, we can find out the area of one tile. Area of one tile, 12 by 12 times 8 by 12 is 0.667 square feet. One tile is 0.667 square feet. If one tile is 0.667 square feet, how many tiles in 12,000 square feet? In 0.667 square feet, one tile. How many tiles in 12,000 square feet? There are 18,000 tiles, right? So now, for 18,000 tiles, you have been given the details as 1,200, 500, 800. So, accordingly, for 1 lakh tiles, the details you are seeing are 7, 3 and 5. Now you can easily make your own cost card and understand it, so I am not doing that. We have already discussed such sums earlier as well. If you have the details for 18,000, then what will it be for 1 lakh? You have to make the cost card, at least for practice, you must definitely calculate the standard cost for actual output of A, B, and C, and when copying the actual cost, do not copy this quantity. You should not write 1200, 500, or 800. If it is 1200 or 18,000 for 1, then what will it be for 1 lakh? So, let me write for 1, if it is 1200 or 18,000, then what will it be for 1 lakh? In the same way, you have to calculate the quantity, the rate is given, you have to take the amount. Similarly, you have to do B and C, which I am not doing. You have to do it yourself. You can do it now if you want, or after my entire video is over. Do it as per your convenience. But you must do it. Alright. Shall we move on to the next? Look at question number 8. This is a missing figure question. So, even in this missing figure question, you will have to make an assumption, otherwise this sum cannot be solved. What is the assumption here? The assumption is that you have to consider the standard output as the actual output, which is 90. How? You see here, the standard mix is given as 50 to 50, 50%, 50%. The quantity is not given, it is given in percentage. For the percentage-based sum, we dealt with processing laws, where we said, assume total input is 100, then it becomes 50 to 50 units, and after subtracting the loss, you get the output. Here, the loss is 10% of total input, so output comes to 90. So, the standard output has come out to be 90. Ideally, the actual output should have been given, based on which we would adjust the standard. But in this question, the actual output is not given anywhere, so we will assume that the standard output itself is my actual output. What will we assume? We will assume that the standard output is the actual output. If you are able to understand this, then that's really great. Now, what is it showing you next? Whatever details are given, put them into the cost card, and then you see that all the required things will come out smoothly one after another. First, enter all the details into the cost card. The material is called A and B, so I wrote A and B. It's 50% each, so we took the total input as 100, making it 50 to 50. The rates are 12 and 15, so I enter 12 and 15. Look at the actual input for chemical B, it is given as 70, so I have written 70 here. Then the price of chemical A is given as 15, so I have written 15 here. Then, normal loss is 10%, so the output is 90, which is clear. Then, cost variance and real variance are given, and it asks to calculate everything. Before using cost and real variances, we have two missing figures, which I have assumed as Y and Z. So, this Y and this Z, we have taken here and calculated 15Y and 70Z. So, the total becomes 50Y, 15Y plus 70Z. There is another formula for real variances, which is total standard quantity minus total actual quantity multiplied by standard weighted average price. So, we took the difference between total actual quantity and total standard quantity. Total standard quantity is 100, total actual quantity is 70 plus Y, so the difference is 100 minus 70 minus Y multiplied by the standard weighted average price, which will be 1350 divided by 100. In this way, we set the material yield variance as minus 135 and gave the answer for Y. We have given the answer for Y and placed Y above. Now, moving to cost variance, we put 1350 minus 15Y minus 70Z, so its value is 650 adverse, so we take minus 650 and solve it. Remember, if you don't take minus 650, it will create a problem. After taking minus 650 and solving, we got Z equals 20. So we have placed this value of Z. In this way, all the figures for your cost card have been obtained. Now what do you have to do? You have to refresh the cost card, and after refreshing it, whatever is asked, you can easily calculate. If price variance is asked, then 12 minus 15 into actual quantity, 15 minus 20 into 70, you can do it easily. If usage variance is asked, then 50 minus 40 into 12, 50 minus 70 into 15, you can easily do it by looking at the cost card. If mix variance is asked, then how will that come? For mix variance, multiply the total actual quantity by the standard proportion, then you will get the revised standard quantity. After that, subtract the actual quantity multiplied by the standard price. Alright. So, how does mix variance come? Total actual quantity into standard proportion, this becomes the revised standard, then you have to subtract actual quantity multiplied by standard price. And since there are only two materials here, it's better if you do them separately. There is no need to make a combined column. You have to do it in this way. Where will the total actual quantity come from according to 70 plus y? How will the standard proportion come? That is 50 by 100, meaning half, or 1 by 2. You have to multiply by the standard price, which is 12, and for actual quantity, take it as minus, so minus actual quantity is 40 and 70. In this way, you will be able to do it easily. You must be understanding how you have to do it like this. And see, I don't know what basic expectations you have from me, but I'm helping you revise. I'm not making your hero in standard costing from zero right now. So now you will have to learn just this much. Now, when they come to the classes, by practicing like this, the student learns it within just 7 classes. Right now we are in revision mode, so in revision mode, keep in mind that in material variance, to crack this sum, we have to assume this 100 liters, and that very liter is the real one. You have to solve the sum assuming this, otherwise the sum won't work. I am moving on to the next question. This is a question on labor variances. In labor variances, sometimes the output is not given in quantity but in standard hours, so at that time, you have to make an assumption that 1 standard hour of input is equal to 1 standard hour produced. Many times in the question, instead of giving standard hours, they give the number of workers, and even in the actuals, they give the number of workers. Just knowing the number of workers is not enough, we need man hours, and to calculate man hours, you multiply by hours worked. If hours are given for the rate, there is no problem. If it's a 40-hour week and the gang has produced 1800 standard labor hours, then if the output is given in output units but also given in standard labor hours, then since the output is given in standard labor hours, this assumption will apply. You have been asked to calculate the labor variances, so first arrange the standard data, then according to the standard, how many hours are required for how many units. We don't know the number of units yet, treat it as blank, and consider total hours for skilled, semi-skilled, and unskilled workers. 32 into 40, 12 into 40, 6 into 40, so we get 1280, 480, 240 for a total of 2000 hours. We know the rates are 3, 2, and 1. So, since nothing else is mentioned, let's assume that 1 standard hour of input is equal to 1 standard hour of output. So, for 2000, it will be 2000. What will it be for 2000? It will be 2000. Similarly, in actuals now, in actuals, people have produced such a big output, so for that, you have spent 28 into 40, 18 into 40, and 4 into 40 hours. So, we have calculated its average, the rate is 432, now you all. According to the standard, the details are given for 2000, so what will it be for 1800? The cost card will be made accordingly, so I have also prepared a rough cost card. You just have to copy the actuals, and here, how did 1152, 432, and 216 come? For interest, it was for 2000, so for 1800, what will it be? Based on that, I changed the overheads by rate. Then, here in science, there are 3 labor categories, so it's better to make a separate column for standard rate into actual hours and standard rate into revised standard, so we can open brackets and calculate the variance properly. If the question asks for labor cost variances, the difference comes from the total of both. If it asks for labor rate variances, then you will open that bracket. Calculated as standard rate times actual hours minus actual rate times actual hours. A separate column is made for standard rate times actual hours. Actual times actual hours means actual cost. To calculate labor efficiency variance, how? It will be calculated by subtracting actual hours into standard rate from standard hours into standard rate. So, by doing standard hours into standard rate, we get the total of the first column, and actual hours into standard rate gives us the total of the third column. If you arrange that, then if you want to calculate the labor mix variance, how does that come? That is calculated as revised standard hours into standard rate minus actual hours into standard rate. You just have to copy the efficiency part. In the mix, you just need to put revised standard hours, so a column for revised standard hours into standard rate has been made. There you will put it, and for the rest, to calculate labor yield variance from actual hours into standard rate, you subtract efficiency and mix. So if you subtract these two, actual hours into standard rate will get cancelled out, and what will remain is standard hours into standard rate minus revised standard hours into standard rate. This will give us our yield variance. Understood? This will give us our yield variance, and this is the answer. This will give us our yield variance. And this is the answer. Hope you understood this. Now, how do we get the revised standard hours? If you have this doubt, at 1280 plus 720, 1280 plus 720 plus 160 you get 2000. Break 2000 into standard proportions. To break it into standard proportions, the easy way is 32 by this, like if the total workers are 50, then 32 by 50. This is the easier way. Otherwise, you can also take 1152 by the total you get here and find the proportion from that as well. However you calculate it, the standard rate is like this. If the revised standard hours are 3 out of a total of 2000 hours, then into the standard proportion, which is 32 by 50. It's easier to do it with the workers. If you don't do it from here, no problem. You can also take 1152 by total, and just like that, the value of 32 by 50 will come as a percentage. In the same way, you have to do it for the other two and take the total. However much you need to reduce, I have already told you the trick for the sum, how to handle it. Next, illustration number 10. Let's move to 10. Here, it is talking about labor time variances. What is being discussed here? It is about labor idle time variances. So what is it here? If you make a cost card, you'll understand details. What is said here? See, for 10,000 pairs of jeans, this is the actual output. You have been given the details of what was the actual hours per unit, what was the standard hours per unit, what was the actual rate, and what was the standard rate, and we had 800 hours of idle time, so standard cost and actual operation cost are our two parts. HRA we have written twice. We have been told the actual output is 10,000 pairs of jeans, so we know the standard hours per unit. For the actual output, how much will it be? 6,000 hours, rate is 120 rupees, standard rate is 100 rupees, so we multiply by 100. In actual, it is 65, so 0.65 into 10,000, that is 6,500 multiplied by 120, which comes to 780. From this, we have to account for idle time as well. 800 is idle time, 5,700 is productive. 6,500 plus 800 is incorrect because actual hours per unit are given, so total hours are only this much. 800 is idle time, 5,700 is productive hours. Now, the question has asked for idle time variance, so idle time variance is the idle time multiplied by the standard rate. Idle time into standard rate. And efficiency variance is equal to 6,000 minus productive hours multiplied by the standard rate. Idle time is written here, and actually, the full rate is used in case of any idle time, but for variance, it is multiplied by the standard rate, and this is an adverse variance. So, the answer will be 80,000 adverse. Alright, so don't make this basic mistake. Students who are not clear with the concept often make this mistake of multiplying by the actual rate. Next, look at question number 11. This has been copied from inter-level maths, and it is asking about both material and labor variances. Alright, it is asking about both material and labor variances. One thing to notice here is that the actual output for both is the same in standard and actual. This is the output. How do we know this? Because the total input is 700 and the loss is 25, if you subtract the loss from the input, you get the output. In both cases, you don't need to change anything for the output. The details given in the standard will be copied. The details in the actuals will also be copied, so the material quantities of 400, 200, 100 will remain as they are. You know the rates 50, 20, 15, you can write those down. The actuals remain as they are. The rate is copied. For labor, the amounts of 100 and 200 are copied, and here 120 and 40 are copied, so the whole cost card is just copied as is. If it is copied, there's no need to make it again. With multiple materials and types of labor, you can make two extra columns, SP into AQ and SP into RSQ. How will SP into AQ be calculated? It's easy. This is SP, this is AQ. Multiply them. How is SP into RSQ calculated? RSQ is the total actual quantity, 750, into the standard proportion. If you look at the standard proportion here, it is 400 by 700, so 4 by 7. So, the total actual quantity, 700 into the standard proportion, that is 4 by 7. 750 into 4 by 7, 750 into 4 by 7 into the standard price, 750 into 4 by 7 into the standard price. Pay attention, where is this 4 by 7 coming from? You can say it from here or from anywhere else, it's the same thing. Total actual quantity into standard proportion into standard price, that's how it comes. And if you total this, you will get the answer. Then, in the same way, for labor also, standard price into actual quantity, SP into actual quantity, 20 into 120, 15 into 240, this is how it will come. If we do SP, UR, and SQ for labor, what will happen? How will SP, this 20, into RSQ come? Total actual hours 360 into standard proportion, which is 1 by 3. 1 by 3 into 1/3. Down into 2 by 3. Now, I have explained this thing. Now, using this total, you can calculate your variance. The solution given by the institute has a mistake in calculating the revised standard average. This error is there in the intermediate material as well as in the final material, and the same mistake is still continuing. So, there has been no change from their side till now. So, things are going on as they have been, and we have also been following the same. But that's why I have corrected it here, and that's also why I have properly explained the working of SP into RSQ to you here. Now you know the total figures, so without looking at the answer below, try to calculate all the variances yourself and see whether you are getting the correct answer or not. Alright. Next, see illustration 12, fixed overhead variance. Fixed overheads can be confusing. Write the formula and review it a few times so it sticks. Just memorizing the formula makes things clear. Normally, what is being said in this? See, first, when we prepare the working note for fixed overheads, what do? We just write down the budget and actual figures. Standard for actual output and do not write actual. When we write budget and actual, the overhead cost given to us is total fixed overheads of 161 and 168. Then we are given the output per man hour. To get the total output, we have to multiply output per man hour by the number of man hours, and the man hours are also given per day. So, we will also have to take the total man hours. So, by multiplying per day by 820 and then by 22, we get the total man hours. From the total man hours, we will get the total output. Then, the number of days is also given as 20 and 22, right? So, in this way, we have both the budget and the actual figures. Now, we have to calculate the overhead variances. It isn't stated if it's fixed overhead, but it looks fixed overhead since days are given. Based on all this, what will we calculate? You will calculate all the fixed overhead variances. Fixed overhead cost variance, standard cost for actual output minus actual cost. Standard cost for actual output, 1,60,000 divided by 1,60,000 into 160, 20 minus 168. Fixed expenditure variance, 160 minus 168, budgeted fixed overhead minus actual fixed overhead. Fixed overhead volume variance. Actual output minus budgeted output times standard fixed overhead per unit. Actual output 160, 20 minus budgeted output 160 times standard fixed overhead per unit. Calendar variance, 22 minus 20 times actual days minus budgeted days times rate per day. 22 minus 20 times 1,60,000 divided by 20. Rate per day, budgeted amount divided by budgeted days. Pay attention calculating capacity variance for fixed overheads. Whenever there is a calendar variance, the capacity variance equals actual hours minus budgeted hours in actual days multiplied by the rate per hour. Calculate budgeted hours in actual days, then multiply by the rate per hour, not per day, but per hour. So, we already know the actual hours, we have calculated the total in the working note. Minus budgeted hours in actual days, that is 1,60,000 divided by 20 into 22, multiplied by the rate per hour. Why do we use the rate per hour? Capacity is the change in hours. Change in hours is at the rate per hour, 160 by 160. Fixed deficiency variance, standard hours for actual output minus actual hours times the rate. Standard hours for actual output. How will it come? 160 by 160 into 160, 20 standard. This 160 given is for this 160, so by doing 160 by 160 into 160, 20, the standard average comes. For actual output minus actual average, 180, 400 into rate, 160 by 160. From this, the efficiency variance will come. If you check everyone's answers, combining calendar, capacity, and efficiency gives the volume. Adding volume and expenditure gives the cost. Combine calendar, capacity, and efficiency to get volume. Add volume and expenditure to get cost. Do this on your own. Pause the video right now and try it so that you gain a bit of confidence. Try doing the working yourself. When you pause the video and try, it's better if you don't look at what's below, just listen to everything. Now, look at this and try it on your own. Alright, did you understand? Have to do it. You have to do it. Next, look at overhead variance using activity-based costing. So, what happens in activity-based costing? Whatever fixed overhead there is, it is treated at the rate of variable overhead. Just like in variable overhead there is an rate amount, in activity-based costing there is a driver's rate and amount. So, like here, the cost of inspection and setup cost, its actual amount is 1760 and the budgeted amount is 2000. And the driver here is saying the number of batches, right? What the driver is saying is, the number of batches and the budgeted production is 10,000 units in batches of 1,000 units each. This means in the budget there were 10 batches and actually it says 8,800 units were made in 11 batches. For activity-based costing, we need a proper variable overhead cost card, which is the standard cost for actual output and actual cost, quantity, rate, amount, driver rate, amount. In the budget, there were 10 batches for 10,000 units, that is 10 batches per 1,000 units. That means, in the budget, there are 2,000 units in 10 batches. How many units are we making? Sorry, we are making 10,000 units in 10 batches, so actually 8,800. So how many batches are needed? 10 divided by 10,000 into 8,800 gives 8.8. It comes to 8.8 batches, but since that's not possible, we'll have to say 9 batches. So, the standard for actual output comes to 9 batches, and what will be the rate per batch? In the budget, our total cost was 10,000. If you make a column, a budgeted column, then in the budget our total overhead is given as 2,000. Our total output is given as 10,000. The batch size is 1,000, so the number of batches comes out. You are able to understand, it's 10. So now, if you want the rate per batch, since here the driver is batches, the rate per batch will be 2,000 divided by 10, which is 200. And how many batches are there actually? Here it is written 11 batches. What is the amount for that? 70,060. So, 11 times 11,000 from 70,060, the rate comes to 160. And now what do we have to do? When calculating variance, do it just like variable overhead variance, variable overhead cost, expenditure, and efficiency. Even though it's called fixed overhead, calculate it the same way as variable overhead. You may label it fixed overhead, but when working it out, use the variable overhead method. So, the cost variance is the cost difference between the two, the expenditure variance is the rate difference multiplied by the actual drivers, and the efficiency variance is the difference between the two drivers multiplied by your standard rate. So, I have done the working here. Now you can notice that. Pay attention. Whatever I said is what's written, and I have told you to do the same in traditional method. In the first part, traditional standard costing means, as we've been calculating expenditure and volume for fixed overheads, do the same. Make two columns, budget and actual. The total amount of fixed overhead was 2,000 earlier, and as per the actuals, if you see, it is 70,060. Output was 10,000, now 8,800. Not involved in batch numbers. Although this is given, it will be useful in ABC, and with these two details, traditional working can be done. If we have to calculate fixed overhead cost variance, how will it come? 2,000 by 10,000 into 8,800, then minus 70,060. Calculate expenditure variance, 2,000 minus 70,060. Volume variance, 8,800 minus 10,000 into rate per unit, which is 2,000 by 10,000. Have a look at it and figure it out. Now do this. Now, remember the concept. In ABC, you have to treat it like variable overhead. So, according to this concept, you have to make the sum. Come to the next part. If there are missing figures in sales variance, then how will the question on missing figures in sales variance be, brother? The question on missing figures in sales variance is always solved by making a cost card. So, instead of a cost card, here you will make a sales card first. So, always prepare the sales card first, enter the budget and actuals, and then write the quantity, rate, and amount as per the format. Then, fill in the details.
For example, if there are two products here, R and S, then write R and S.
Standard units are given. See, for S it is 400, and for R, actual is given as 500. Then, for price, standard is given as 12 and 15. For actual, it is given as 15 and 20. Alright, so whatever information you have, just fill it in. So, two things are missing in the total. Can you see it? So, do you know the sales volume variance for this now? For which one? For R, you know the volume variance, so use that. How will this come? Our minus bow into standard price is equal to 1200 favorable. Favorable means in plus, so what is our? Ours is 500, we don't know how much bow is, that's what we have to find out. What is the standard price? 12. This is equal to 1200, so from this, we'll get bow. How much will bow be? 500 minus BO is equal to 200, so BO is equal to 400. Okay, so we get 400 here. See, you just have to figure out these numbers in the working notes first and then put them here. So, 400 times 12 is 4800. Now, this one is missing, so for that, the sales mix variance for both the products together is given as 450 favorable. So, for this, you'll have to apply the formula. How will the mix variance for both come in a combined way? So here, you'll have to assume this as x. This will be 500 plus x, so you will say the total actual quantity is 500 plus x into the standard proportion 400. From 400, you can see it's 1 by 2, so it's into half, right? How will the mix variance come? Look, let me write the formula first. This time, it's the opposite in sales. Earlier, it was RSQ minus AQ. Now it will be R minus RSO into standard price. You have to apply this formula and combine both of them. So, what is R? What is R? R is 500. I am doing this for the first product. 500 minus RSO. How will that come? Total actual output into standard proportion. After doing both of these, multiply by the standard price, which is equal to 12 in the case of the first product. Plus, what is there in the second product? X minus 500 plus x into half is also here, and here it will be multiplied by 15. Whatever answers you get for both, solve the total of both, and if it is equal to, say, 450 favorable, meaning if you solve by taking positive 450, then you will get the value of x. Once you have the value of x, the cost card is complete, cost card, sales card complete, sales card complete. So now, whatever question marks have been asked, you can easily find all of them. So the main working of this follows this kind of flow. First, in working note 1, you will make a sales card. In working note 2, you will take the variance that has been given. In working note 3, you will take the next variant and then solve it. So your x, y, whatever it is, the missing figures will be found. Once the sales card is complete, all the variances will come out quickly. Now you should put in the effort. If you think that till now you haven't done it and you'll be able to solve it directly in the exam, it won't happen. If you go after seeing and practicing, there are still chances that you'll be able to do it in the exam. Alright, let's move to the next one. Illustration number 15. Are you enjoying it? If you are enjoying, then brothers and sisters, raise both your hands, whistle, clap, and say, "Hail to today's joy." Saying joy or cheering up a bit really lifts your spirits from within. Anyway, let's move on. Yes, look at the next question. See what this question is saying. There are 4 salesmen here. Alright, the zonal sales officers are the same as the salesmen. They have been given a standard cost of sales target. Target means the budgeted cost of sales. You can say budgeted cost of sales and target means budgeted. Then it tells us how much commission these people have earned, and since the commission rate is 5%, from that we can find out the actual sales, which is equal to actual commission divided by 5%. Then, figures for variance are given for sales price, sales volume, and it is asking for the amount of target sales and the amount of margin fixed. That means you have to calculate the budgeted sales and the budgeted margin. In this case, what do we have? We have the actual sales for all 4. we will put in the figures for all 4 by dividing the commission by 5%. Then, when we add the sales price and volume variance, we get the total sales variance, and when we adjust the actual sales with the total sales variance, we will arrive at the budgeted sales. So, this is how the budgeted sales will be calculated. Then, if we subtract the budgeted cost of sales from the budgeted sales, we will arrive at the budgeted margin. See, this is how it has to be done. First, we calculated the actual sales. By adding both variances, we got value variance. After adjusting these, we arrived at budgeted sales. Whether to add or subtract while adjusting needs to be decided. You have to think about that yourself. You need to use your mind to figure out that this is the actual sales and the sales value is adverse. This means the actual sales have decreased. Adverse means actual sales have decreased, so if it comes more than the budget, then the budgeted sales will be 6 lakhs. If you subtract the budgeted cost from that budgeted sales, you will get the budgeted margin A. Got it? Now come to the next question, number 16. Guys, come to question number 16. See what question number 16 is saying. Please pay attention. See what number 16 is saying. This question is a favorite in exams and comes up very often in the exam hall. If we don't know how to do this, and if you haven't practiced, you won't be able to do it. Alright, so in this, it seems a bit different from the normal concept because the output is not given here. So the very first working note we make here is to find the ratio of AU to BO. And how does that come? The value of sales that is given, we refer to that ratio. It is supposed to be the sales price ratio into the volume ratio. Sales price ratio to volume ratio. Basically, what is the concept? Actual sales by budgeted sales is equal to actual price by standard price into actual output by budgeted output. So, you should understand this breakup. It's a very easy breakup and these details are given to us in the question. Actual sales are 129.6, budgeted sales are 120, and it is talking about actual price by standard price. Here, our price has increased by 20%. In case of sales, this van became 20%. In a way, if it has increased by 20%, then if it was 100 earlier, now it has become 120, and from this we can calculate AU by BO. So what will AU by BO be? That will be, if you cross multiply, then it will come to 129.6 by 144. If this goes to the other side. So, by dividing this, it comes as divided by, which is 0.9. So this is your AU by BO, this is AU by BO. Now after this, it is saying, prepare a profit variant from the above data. If you have to calculate the profit variant, basically you have to put everything into reconciliation. So, let's prepare a reconciliation statement. First of all, we will enter the budgeted profit in it. So, our budgeted profit, if you look at last year, that will be called the budget. The current year will be called actual. So, the budgeted profit is 5. Now after this, we have our standard variance. Like earlier, the sales price variant comes, so normally how does the sales price variant come? Actual price minus budgeted standard price multiplied by actual output. If you open the bracket, so it will be equal to AP into AU minus SP into AU. AP into AU, actual sales minus SP into AU. How will SP come? If you can understand that AP and SP, the difference is 20%. We don't know SP and all that, so we can say SP is equal to, if you cross multiply, AP is 100%, so you can say it is AP by 120% into AU. So this comes as actual sales minus actual sales by 120%. So we know the figure for actual sales, which is 129.6 minus 129.6 divided by 120%. By doing this, you will get the sales price variance. There is a shortcut to do this. If you don't want to write such a big calculation, you can simply say that these sales happened at a price which is 20% extra. So if it happened at 20% extra price, then this is 120%. So if we have to find 20%, then if we do 129.6 divided by 120, the answer comes to 20.6, and since the sales price has increased, it is again, so you can keep it as favorable, that is positive. If it is adverse, you can keep it as negative. So this will now be the sales price variance going forward. In the same way, for profit volume variance, you can use this shortcut. In the exam, you can easily do profit volume variance, the next variance. One way is to do it by opening the brackets as usual, and the other is a shortcut method. If the volume ratio is 0.9, you can say that 10% is going adverse. Instead of 100, if it comes as 0.9, that's 90%, so 10% is adverse. Whatever the budgeted profit is, say 5, take 10% of that. 10% of 5, and since this is adverse, just put 0.5 in the minus. It's a very easy method. But with cost variance, there's a bit of a hassle. In cost variance, there are a few changes here. Prime cost is one type of cost, and variable overhead and fixed overhead are other types of costs. Prime cost should be treated like material cost and variable cost, okay. Think of it as a combination of material cost and labor cost. If prime cost is given, then just like you treat material cost, for prime cost variance also, there will be an expenditure variance, that is, a rate variance, and the other will be a volume variance. How will the rate variance come? Exactly in the same way that 91.1 is after a 15% increase. 91.1 is after a 15% increase, so if 91.1 is 115%, then what will 15% be? So if you do 91.1 divided by 115 and then multiply by 15, you'll get the answer, which is 11.88 approximately, because the price is higher. Then, after the prime cost expenditure variance or the rate variance, you can call it the efficiency variance. You can also call it the usage variance, but there is a bit of confusion about how the usage variance comes or how it used to come earlier. It used to be calculated as standard quantity minus actual quantity multiplied by the standard price. If you open the brackets, it will come as standard quantity in standard price minus actual quantity in standard price. Now, SQ in SP means standard cost for actual output, right? And how does AQ in SP basically come? If you can understand that SP, just like here AP was calculated by dividing by 120%. Here, SP is equal to, as we have put here, AP divided by 120%. In the same way, here also, if AP, actual price divided by standard price, is equal to 115%, then what will SP be equal to? It will be AP divided by 115%, so SP is equal to AP divided by 115%. You can apply it here as well, so what will be the standard cost for actual output? Budgeted cost, now, divided by BO minus actual cost divided by 115%. So, what will be the budgeted cost? What is the budgeted cost? 80 now divided by BO, 0.9 minus actual cost. What is it? What is the actual cost? What is the actual cost? What is the actual cost? 91.1 of prime cost divided by 115%. This is where it hurts a bit. Everything else is easy, so if you open this bracket, brother, you can remember it. 80 into 0.9 and 91.1 divided by 115%, so this is coming to 7.22 adverse, it's coming in minus. Now, in the same way, for variable overheads here, they're also 10%. In case of overhead, overhead means both will be included. It will come in both variable and fixed. Alright, so for variable overheads also, we will have to do it in the same way. You can call it the price variance of variable overhead. How will the rate variance come? The one that is given here has been increased by 10%. After increasing the price by 10%, it became 24. So the 10% part is the rate variance, so it is 110%. What will happen at this 10%? So if you do 24 divided by 110 into 10, the answer comes to 2.18 adverse. Then what will be the expenditure variance of variable overhead? There is a expense of variable overhead. What will be the efficiency variance? You can just copy this itself. Once you have done the hard work, you won't have to do it again. Budgeted cost into AU by BO minus actual cost by the rate that has increased, which is by 110%, so budgeted cost. How much variable overhead has been given? 20 has been given, so 20 into 0.9 minus actual cost, how much has been given? Actual cost is 24 by 110%, so solve this and see, you'll get the answer. It is coming to 18, and when you do 24 by 110%, it comes to 21.81. So 21.81 minus 18, this is coming to 3.82 adverse, 3.82 adverse is coming. It is coming to 3.82 adverse, right? And when it comes to fixed overhead, how does the expenditure variance come in that? That comes by directly subtracting. It will come by subtracting 15 and 18.5, so you should not apply that funda there. In the flow, the way it is applied in variable, it is not applied the same way in fixed. So here, what is the fixed overhead expenditure variance coming to? 3.5 adverse, and now we have to do the fixed overhead volume variance. So how will the volume variance come? That 90% is given, right, for the volume from which it is clear that 10% is adverse. So, because your ratio is 0.9, just like in profit volume, how did we calculate 10% of 5? Where did that 10% come from? If the ratio is 90%, then 10% is running adverse. Similarly, in fixed overheads, if the value here is 15 and 10% is running adverse, then taking 10% of 15 as per the volume ratio, this 1.5 will come as adverse because the volume has come down. This 3.5 will also come as adverse, so solve this. See, the answer will come. Try it out. Add all of these, 5 plus 21.6 minus 0.5 minus 11.88 minus 7.22 minus 2.18 minus 3.82 minus 5 minus 4. It is coming, this is your actual profit for the year, which is minus 4. If you see the answer is minus 4. And here, the solution that has been given, in that they have added a few of their own things. The way I have explained to you is more accurate and more perfect. I have shown this to you step by step. There is another question ahead which is a bit easier compared to this one. You have to try that one on your own. Alright, let's move on. This is an important question. Deserves doing again. Brother, I finished it, but you still need to do it again. You can't do it alone. Then you'll see, you'll get stuck in some variant. What is being asked in question number 17? Look. Sales figures are given. Then standard cost of material, wages, overhead, profit. Then the variances are given. For material, price, usage, total are given, but nothing is given for labor. For overhead, expenditure, volume, total overhead are given, but nothing else is provided. Then it says, standard price of material used is 600 per ton. So now it is becoming clear that standard data and all is being given. If you start making the cost card, then we made one cost card and in that, we wrote standard cost and actual cost. As we get the details, we will start filling them in. You have to answer while reading the question. It's not like you just sit till the end and then keep thinking about it. In the beginning, after reading the first few lines and the requirement, they decide whether to do it or not. If you have to do it, you will have to do it while reading along. You can't decide after reading everything. If time passes, then here we have entered 600. Then it says, for 1 ton, 2400 units are produced. From 1 ton of material, 2400 units are made. it is expected this much will be produced. This line is very important. The whole game changes because of it. For now, just note this. For 1 ton, 2,400 units, and for 4 weeks, we operate a 40-hour week. Its rate per hour is 40, so we have written 40 in the labor section. There are 60 employees working as direct labor, so 60 multiplied by 40 gives 2,400 hours. But those 2,400 hours will be the total actual hours. The total actual hours will be 60 multiplied by 40, which is equal to 2,400. The standard performance is that each employee should produce 1 unit in 3 minutes. So it takes 3 minutes per unit, and there are 4 working weeks, right? There are 4 working weeks in October. What does this mean? What is the meaning of this? This line that is given here, it's completely like a witch. The lines that are like a witch, you know, they are very scary. If you read this line, you'll get trapped. So, it is given that there are 4 working weeks in October, and you might feel like just multiplying it by 2. And do you know what a witch does? She calls you towards her. Once you come, give her a hug, and if you read the question, if you read that line, she will drown you with the whole question. Alright, so the budgeted fixed overhead for October is given as 76,800. Alright, look at the actual data. It's talking about used during the week. Everything is for during the week, meaning we have to talk about just 1 week, so there's no need to multiply by 4 weeks. Even the budgeted overhead is given for the whole of October, so we'll have to calculate it per week. Material used during the week is 20 tons, set 620, so I have written 20 and 620. Then, during the week, 4 employees were paid at 42 rupee per hour, 6 were paid at 38 rupees, and the remaining were paid at the standard rate. So, the total hours for us, according to 60 workers, came to 2,400. So, for that, 4 employees at 42 rupees, then 4 employees at 42 rupees, then 6 employees at 38 rupees, and then 50 employees at 40 rupees, 50 employees at 40 rupees. Alright, so 4 times 44, 6 times 44, 50 times 44. We have entered this. The standard rate for these remaining 50 employees we already knew was 40. Alright, so if you total this up, it will come to 2,400 only. But its breakup has come like this. So in this way, the actual cost of labor will be correct. Now, I still haven't explained this part. I've only explained as much as I've marked with the red tick. Ignore whatever has already been done. Then what is it saying next? The overhead incurred was 18,000, so this is for the entire week. So let's prepare the working for overhead. We wrote incurred as 18,000 and the budgeted amount per week will be 90 times 200. So right now, we don't know the output properly. Alright, the question about output is not here. The question here is, where will the output come from? The thing to look at here is the working for output to see how it is coming. So how will the output come? From 1 ton, 2,400 units are expected. So if we use 20 tons, the expected output will be 48,000. So I have written 20 into 2,400, 48,000. Now see where this has come from. This budgeted output has come by multiplying the actual quantity of material by 2,400. And this is one way, meaning we have to go in reverse, that if 1 ton gives this much, then how much will 20 tons give? So whatever is supposed to come, that will be the budgeted output. Alright. After that, in the question, you were given some variances, material price and usage. If you use price and usage, suppose I use the usage variance. This was my note 1. This was my note 2 for overheads. Then in note 3, I used the usage variances. When I put it in the usage variances, the standard quantity that I got from here is 19.5. I know the standard price, I know the actual quantity, I know 20, I know all this. So the standard quantity is 19.5, so I have put 19.5 here. What I did was, I put 19.5 here, and from this 19.5 and 600, the amount will come. this amount will also come. Alright, even now see, it has come only from 19.5, the 19.5 that I put here from note 3. Now, what is still going wrong for us? We don't know the actual output, so think about it. This standard quantity is running for the actual output, so that means the output from this will be the actual output. So if one tone is supposed to produce 24 units, then how many units should be produced from 19.5? So if we do 19.5 into 2400, then this is the actual output. So how did this come about? This came from the standard quantity of material for actual output multiplied by 2400. The beauty of this sum is that when it says standard quantity of material for actual output, it will give you the actual output. But for this one, no one can imagine that the expected output will come from the actual quantity of material. When you calculate the expected output from the actual quantity of material in this way, it is called an ex post budget. One is the original budget, which we plan at the beginning. The other is the ex post budget, which we derive based on the actuals. So, with the resources we currently have, we can do it accordingly. So, the ex post budget gives us the budgeted output. So, this output that has come, 48,046,800, with this all the overhead work will be managed. And from this 46,800, we have calculated here that it takes 3 minutes to make 1 unit. In one question, it was said to multiply by 3 and divide by 60, and by doing that, 3340 hours were calculated, and now this working will be done. Understood? Now, until you actually do it yourself, it won't click for you. Alright, and if you have done it before, then now it will click for you. Even now, you are thinking that just by looking at this much, you will go to the exam hall and manage to do the same thing. You are mistaken. Do you remember what I said earlier? Keep a dog, keep a cat, keep a cow. Hey, you can get a hug but don't have any misunderstanding, brother. Don't live in a misunderstanding. Don't be under the illusion that you can do it without actually practicing. So, once again, hide this part, read the question up to here, and then try making notes 1, 2, 3 again to see if you can complete the entire cost or not. And if you get stuck, don't just quickly peek at the answer. If you get stuck, struggle a bit, let yourself feel a little discomfort inside, and then see whether you are able to do it or not. If you manage to do it, then it will be a celebration for you, absolute celebration. Once the cost sheet is prepared, you can quickly calculate all the variances asked in the question. Material variances, labor variances, overhead variances, whatever is asked in the question. If you have to complete the P&L statement, then just fill in everything here. This incomplete statement given here is what you need to complete. So, whatever variances you don't know, you have to fill those in, and whichever amounts you don't know, like the standard cost of material, standard cost of direct wages, you will have to fill in those amounts as well. Understood or not? Basically, you just have to complete the reconciliation. That is very easy, so I am not going into that. This one is also a very easy question, the ACE one. If you do one sample from above, then I am not going into this one either. You should try practicing this yourself. Next, this question is about fixed overheads. And by combining variable overhead and fixed overhead. So, has a flexible budget been given in this? Alright, then below it is written that the normal level of activity is only 5, so we will use the details of this 5,000. The main budget will be prepared based on this only. Actual results have been given, and you have been asked about the cost volume expenditure of fixed overhead, the cost efficiency of variable overhead, expenditure and efficiency, capacity and activity ratios, and also the C ratio. Alright, so what will we do first to deal with variable overhead? We will prepare a variable overhead cost cut. How will that be done? It will be done by calculating the standard cost for actual output and the actual cost. The rate amount will come, the rate amount will be calculated. Here, the details of the hours have been given. So the detail given here is 5,000 hours. But that is for 10,000 units. What is the actual output given? 10,400. So, 5,000 divided by 10,000 into 10,400, that's how it will be. In 5,200, not the rate, if you do 5,000 divided by 10,000 into 10,400, you get 5,200. A rate. What will happen? What will be the rate? What will be the rate? Here, the variable overhead is 1,000 rupees and that is for 5,000 hours. So if you do 1,000 divided by 5,000, you get 0.2. So here, the amount A will be 1,040 and in actuals, everything is given here. 900 rupees is the amount, hours are 4,800. So if you do 900 divided by 4,800, you get 0.1875. This is done for variable overhead, now for fixed overhead. Until you take the question into your own hands, you won't be able to solve it. What is the budgeted and actual amount for fixed overhead? The budgeted amount is 5,000 and what is the actual amount? 5,100. What are the working hours? Here, it's 5,000, 5,000 and here, for hours, for our 4,800 units, how much is it? Here, it's 10,000 and here, the actual output units are 10,400. That's it, I can't do any more for you now. Now, using both of these, you have to calculate both variances. I've been explaining this from the beginning, and for all three ratios, you need to prepare 3 working notes. The standard are for actual output, we've already done that. From 50 to 100, we get the actual hours, which are 4,800, and the budgeted hours, as shown in the question, are 5,000. That is visible in the fixed overhead section, so all 3 ratios will also be calculated. All done just like that. Did you understand? Great job, well done. Alright, it's been put in. Did you get the answer or did you leave it here? Those who haven't done it yet, you'll have to do it once. How many times should I say it? Are you able to hear or not? Next question, which is number 20. ABC Limited adopts the standard costing system. The standard output for the period is 20,000 units and the standard cost and profit is within that. So, material is 3 units at the given rate, alright. Labor, direct expense, variable factory overhead, fixed admin overhead, total cost, profit, selling price, actual production and sales are being given. Actual output 14,400 number price revision by government during the period following are the variances worked out at the end of the period. No price revision means SPV is coming to 0. No price revision means that SPV is coming out to be 0. Then what it is saying is that the cost of material has increased here. There is a price usage variance. For labor, it's rate and efficiency. For variable, it's expenditure variance. For fixed, it's expenditure and volume. Alright. For admin overheads, both expenditure and volume are given, which means it has to be treated like fixed overheads. It is asking you to ascertain the details of actual cost, that is, you have to find out the actual cost. Prepare the P&L statement for the period showing the actual P&L. Actual P&L means you have to show all actual costs deducted from actual income, and then you also have to do the reconciliation. Alright, so how do you prepare the actual cost sheet? Do you remember when the actual cost sheet is given here with the variance and we know the standard per unit? So, for example, this item, this is the standard per unit, right? And we know the variance for each item. So what will we do? We will calculate the standard for actual output. And then we will take the total variance. From this, we will get the actual cost. Alright, like if it is 4.5 per unit, and we know the actual output is 14,400, then if we multiply 4.5 by 14,400, it will come to 64,800. And if we take both the variances of material, then it will be added. And if we take both of these, what will we get? 4, 5, 0 and 1050 or 3200 added, so we have put 3200 here. $64,800 or $61,600. 3 and 2. In the same way, you have to do the entire calculation. Alright, this is how you can work out the variable one. You can also do the fixed one, but you have to use it for fixed overhead cost variance. Remember, how does the fixed overhead cost variance come? Standard fixed overhead for actual output minus actual fixed overhead. How will the cost variance come? If you add the expenditure and volume of fixed overhead, you will get the fixed overhead cost. Here also, if you add expenditure and volume, you will get the fixed overhead cost variance or admin overhead cost variance. Saying it once, alright. If the expenditure of the variable is given, the efficiency of the variable is not given, then how will it happen here? If the expenditure for variable is given and efficiency is not given, then how will it be done here? Tell me, think about it, take a minute to think. What could it be? So this is its impact. When only the expenditure of variable overhead is given and efficiency is not given, then we will assume that this one is varying. It varies with output, and in varying with output, efficiency variance does not come. If it was varying with us, then efficiency variance would definitely come, because if there is efficiency in labor, then there should also be efficiency in variable overhead. If there is efficiency in labor, then efficiency in variable overhead must also be there. Since that is not given, it means it is the one that varies with output, so how will we do the variable overhead? If we do 0.25 into 14,400, then the standard for actual output will come. So, the variance that is there, the expenditure variance itself is considered as the cost variance. Sure. Alright, if it varies with output, then the expenditure itself is considered as the cost. So this is the trick for it. Once you understand this, that's it. You have to do everything using the same pattern, and as you keep doing it, the total cost will come, and here, whatever the variance is, just leave it. The total of the actual cost will come. Alright, then if we have to find the actual sales, the question itself says that the sales price has not been revised, so the 10 rupees that we had assumed, we will take the same here and do 10 into 14,400. It will come to 144, so the actual profit is right here. If you observe and understand, the actual profit will come right here. Okay. You just have to keep continuing in the same flow. There is no variance in direct expenses. There is no variance in direct expenses, so if there is no variance, then the standard amount is the same as the actual amount. Since there is no forced variance, the actual profit has come. In this question, it was asked to show the actual sales and reconcile the actual profit, so you have to prepare a reconciliation statement, and you already know how to make a reconciliation statement. I have explained part A to you. What needs to be done in part B? In part B, you have to reconcile, right? So, standard profit means you should start with the budgeted profit. Once you know how to get the budgeted profit, you know the budgeted profit per unit. You will do 1.15 into 14,400, that is, multiply by the budgeted output. Multiply by the budgeted output, so how much is the budgeted output? 20,000 is, so 1.15 into 20,000. So, this is your budgeted profit. After that, all the variances, sales price variance, which is given as nil in the question. The question clearly states that there is no price revision, then comes the profit volume variance. That we will have to calculate ourselves. It might not have been given here, so how will it come? Our minus bow. What is our? 14,400, bow is 20,000 multiplied by the standard profit per unit, which is 1.15 as given in the question. So, the volume variance comes out. After this, whatever cost variances are given in the question, you will write all of them down. Once you write all of them, you will get the actual profit, and this actual profit should match the actual profit calculated above. If you have understood, then part B has also been explained to you. Now go ahead and do it. What are you waiting for? Do it, do it. Shall I do it? You do it. Alright, very good. You will be able to do it. I am estimating this about you. Yes, next is this reconciliation question, and this is a KG question, so don't copy from me in this one. Do it on your own. Quickly make the cost card and try it out. Do it right now in front of me. Pause the video and do it now, because till now everyone was just copying. There's no benefit in that. Before you start this, read one more line that says material price variance. It is written here, extract at the time of receipt of materials, which means the single plan is being followed. This means that for material price variance, you have to take SP minus AP into actual purchase, and the actual purchase is given right here next to it. Material purchases 20,000 for A and 1,100 for B. The quantity given above must be the consumed quantity. Alright, so what is the question actually asking you to do? Calculate all the variances and then show the reconciliation, so you have to try it on your own. The first thing you need to do is try it yourself. Please pay attention, you have to try it on your own. You have to try by yourself, try by yourself, try by yourself, then you proceed. First, pause the video and give it a try. Pause the video and try it out. Alright, now I am assuming that you have tried it and now you are checking along with me. I have already solved it here. You can have a look at it. The cost card has been prepared here for material, labor, and also for variable overhead. So, in the cost card, you have to show the standard cost for actual output, which is 10 kilograms and 5 kilograms quantity. The actual output here is 2000 units. So when you do 10 into 5, 10 into 2000, 5 into 2000, you get 20,000 and 10,000. The rate has been entered. The actual amount has come. In the actuals, I have entered the consumption. Once, I removed the adjustment for stock. I have only entered the consumption. This is an easy way to sum up and keep it as a shortcut, and no stock adjustment has been shown. Here, what we will do is, based on this, we will calculate the material usage variance. According to this, we will calculate the usage variance. Based on this, you may not want to calculate the cost variance. If you calculate the cost variance like this, it will be wrong. Do not calculate the cost variance in this way. This is the only difference if you are showing it like this, and if the stock adjustment is not shown here like it was in the C and Z sum, then if you haven't done it that way, you need to remember that we will not take the cost variance from here. That's why the total was removed. Just take the price and usage ones and also take the mix and yield. How will the price come in price usage? It will come from the formula. How will the usage come? For usage, the bracket that is opened. If you open the bracket of SQ minus AQ into SP, then SQ into SP will give you a different total, and for AQ into SP, you will have to take a new total. So, do the mixed yield as you want, do the usage as you want, just don't take the cost variance from here. Alright, don't use the cost variances from here. Don't use MCV from here because this is a single plan and we haven't done stock adjustment. Okay. As there is no stock adjustment, there is no stock adjustment here. I have explained this to you from my perspective because I approached it with that mindset here. But if you do it by making stock adjustments, your answer here will be a little different. You can proceed as per your own method. Then what about the labor? For labor, 5 hours at 5 rupees each for 2000 hours totals 10,000 hours at 5 rupees each. 10,500 and 10,300 are given. From 10,500, 200 hours are idle and 10,300 are productive. Accordingly, I have broken down the 10,500. For variable overhead, 10,000 at the rate of 5 hours for 2,000 hours comes to 10,000. For direct, 12, so it comes to 1,20,000. And here, for variable overhead, you should take it on produced hours, on productive hours, not on total hours. Variable overhead will be calculated on productive hours. Idle hours have no relation with variable overhead. Then, when you have to do fixed overhead, write the budget and actual output for it. Here, the annual budget is given as 25,200, so for 1 month it will be 2,100 and the actual output is 2,000. How did the fixed overhead amount given here come to 52,500 rupees? The fixed overhead per unit is 25 rupees, so if you multiply 25 by 2,100, you get 52,500 here. The actual amount of 56,600 is given here, and we have also taken the working hours. The working hours are 10,500, and yes, the working hours are 10,500, 10,500. So this is our fixed overhead sorted. After this, we have to calculate our variance. So, when you do the price variance in material, you have to do 5 minus 5.25 multiplied by the quantity purchased. Then, material usage variance will be calculated in the same way as I have explained above. For mix and yield, calculate them as usual. For cost, if you haven't used the stock adjusted cost card here, then for that cost, just write price plus usage is equal to cost. If you write the stock adjusted one here, like you did in C and Z, then here your cost will be A, which comes by subtracting these two. Similarly, for labor, you will get rate, efficiency, and idle time variances. In variable overheads, there is no idle time, so you will get rate, efficiency, and cost variances. If the output and fixed overhead amount are given for fixed overhead, then expenditure and volume variances will come. If working hours are given, then capacity and efficiency variances will also come. So, when you put all these into the framework of a reconciliation statement, the reconciliation will also be prepared, which is asked in part B of the question. Are you normally seeing this in the question? It is saying standard profit, so standard profit means you can consider it as budgeted profit. You have to reconcile budgeted profit with actual profit. First, show the sales price variance. Sales price variance is nil because the government has not revised the price. Sorry, sales price variance is not nil. Sales price variance, yes Nilu, is there, but there is no point about the government. From 225,225 it is clear the selling price variance is nil. You can say SPV is nil, but you will calculate profit volume variance yourself, and after that, if you put all cost variances in, then the actual profit will come, which is the one given here as actual profit. 64, 65, how much is it? 65, 7,500, it's 67,500, and when you reconcile the actual profit, if you see, it is coming to 67,450 rupees. So, there is a difference of 50 rupees. So, one reason for this has been asked in part 3, why is this difference coming? So, this difference is coming because here, in the working, the price variance has been taken entirely on the consumed amount. This is the cost taken for the entire consumption. Alright, and the difference that is coming when we calculate the price variance on the quantity consumed versus the quantity purchased, that itself is the reason for the difference. You have to look at this separately here. You won't understand it until you complete the whole thing. If we do this on the consumed quantity, it comes to 1500. If we do it on the purchase price and purchase quantity, it comes to 1550, so the 50 rupee difference that is coming here is the same thing being shown here. Normally, it matches, but here it will not match. Because of the single plan effect. I hope you have understood. But only if you complete it fully, will you truly understand 100% of what I am saying from the heart. Right now, you must have understood about 50 to 60%. Now, what needs to be done after this? Basically, I am repeating that all the variances have come. Now make the reconciliation statement, take the budgeted profit, and after the budgeted profit, sales. The price variance are shown here in blue, and then you calculate the profit volume variance yourself. AO minus BO into standard profit per unit, that's how it will come. Then put in all the cost variance that we calculated above and see the actual profit, which is supposed to come to 67,450. If it came to 67,450, then what is the reason for the difference? Why is it 67,450 here and 67,500 there? The reason is that here, the price variance have been calculated on purchase, whereas there, it has been calculated on consumption. That's why there is a difference of 50 rupees. Understood? Okay, now the last question. This one is the same last year and current year one. But here, this is the current year. This is the last year, so for last year, this budget will be made. Pay attention, and even now, it's the same thing. The selling price is more than 10%. Alright, but there's something new in this. They have given the details. By giving these details, the working for material and labor in usage variance becomes a bit easier. You might remember, In material usage variance and labor efficiency variance, there used to be a lot of calculations written. There won't be a need for things like calculating budget cost as hour by bow. That normal cost will be there from the start. But you will still have to do the hour by bow as the first working. So, what's the issue here? Output is not given. What will you say if the output is not given? So, you have to calculate the hour by bow ratio. So pause for a moment and try to work out the hour by bow ratio on your own. Then check it along with me. It will come in the same pattern. Pause and try to work out the sales value. What are you doing? Sales value ratio is equal to sales price ratio multiplied by volume ratio. Sales value ratio is actual sales divided by budgeted sales. Price ratio is actual price divided by standard price, and volume ratio is hour by bow, actual sales. If you see 770 is actual sales, budgeted sales is 600. AP by SP is 110%. If we multiply by hour by bow, then by solving EO by bow, it comes to 770 by 660, so this is equal to 7 by 6. So you can call this 7 by 6 as well, or you can say 1111.67%, or you can also say 16.67% favorable. So this is note 1, like earlier we got 0.9, similarly here we have got this value. Now, in note 2 and 3, what will we do? Using the details given for material and labor, we will prepare the cost card. Standard cost for actual output and actual cost for both material and labor. Now pay attention, there is a twist here: quantity, rate, amount, quantity, rate, amount. See, there is no hassle at all with the actuals. Actuals write 324. Wages write 137 variable overheads. That will vary along with labor. So write 69 for variable overheads as well. This is the actual amount, and these three amounts are for the budgeted. This is for the budgeted output. This is for budgeted output, but this is not useful for us. We need to bring it to actual output. So what do we do to convert the budgeted to actual output? We will multiply the budgeted amount by hour by bow, which is 7 by 6. This is the main twist. This is coming to 350. For labor, how much will it be? 120 into 7 by 6. So, for labor, it comes to 140. How much is coming in variable overheads? 60 into 7 by 6. This is coming to 70. Then what is the rate of 350? What is the rate? What is the rate? For the rate, we know the quantity. 1,20,000. So 1,20,000 is the budgeted quantity. Here, the year is written incorrectly. Alright, it won't be 1415, it will be 20 and 21, so 1,20,000. It was consumed, and later 1,35,000 was actually used, so here we have put 1,35,000. Let's write it as 1.3 lakh rupees in lakhs. So this comes to 1.3 lakh kg, and here it is given as 1.2 lakh. Look, pay attention, it is given as 1.2 lakh. This is budgeted, so this 1.2 lakh is your budgeted amount, so it will be for the budgeted output. But we need it for the actual output, so we will also multiply by 7 by 6 here, and this will become 1.4. Pay attention here, this is the main working, that output, quantity, and amount have been changed by 7 by 6. Now, for the rate, if we do 350 divided by 1.4, the rate comes to 250. And if we do 324 divided by 1.35, the rate here comes to 240. Now, similarly, you have to try for labor and variable overhead. Both are based on hours. Here it is 24, here it is 26, so it is 26 lakhs. Here, we have written directly 26, 26 and 24, so for 24, it will be 24 into 7 by 6, so this comes to 28, and here also it will be 28. So, 28 and from 140 it comes to 5, 28, and from 70 it comes to 2.5. 70 divided by 28 gives 2.5. Then, when we do 137 divided by 26, where did this 137 come from? The 137 has come from the question itself. When we do 137 divided by 26, we are getting 5.269 or 27. If we do 69 divided by 26, here we are getting 2.65. So, when we do 69 divided by 26, it comes to 2.65. So, with this, our cost card is ready, right? So, these three variants will become very easy. Now, we have to do the reconciliation. Alright, so in reconciliation, the budgeted profit is the last year's profit, which is already there. 940 is the budgeted profit, last profit which is 40. Then what you have to do is the sales price variant. I will do it using a shortcut. Alright, sales price variant, if it is said that the sales price has increased by 10%, then it has increased by 10%. This means that this 77 is at 110. So if we do 77 divided by 110 into 10, then how much do we get by doing 77 by 110 into 10? 70 is coming. So if 70 has increased, then it's favorable. Now, profit volume variance. How will profit volume variance come? That will come from the volume ratio. 16.67 is favorable, so take 16.67% of 40. If you calculate 16.67% of 40, it comes to 6.67, which is favorable, meaning we'll keep it as a plus. If it's adverse, then we'll put it as a minus. So, 6.67 has come, and as for the cost variance that need to be calculated, I won't be doing that. You can easily calculate those now by looking at the table, MPV, LRV, LEV, then variable overhead expenditure, variable overhead efficiency, the cost guard will come from there. Then there is fixed overhead here, 150 and 180. So, if we look at the fixed overhead expenditure, it has gone from 80 to 150, which means 70 adverse. And if we calculate the fixed overhead volume, what does the shortcut for volume say? The budget figure, 80 into 16.67%. So, 80 into 16.67%, which comes to 13.33. Alright. Which comes to 13.33. So from all of these, the actual profit will be calculated. It's clear that from all of these, the actual profit will be calculated and it should match what is given here, which is 90. Now, you have to do this calculation yourself. What was happening in the previous one? Here, there was a bit of extra working involved. What was the reason for that? The reason for the extra working in the previous one was that it was not possible to prepare a cost card. So, you need to look at both sums once, this one and another similar sum that we did earlier. Alright, and both these sums are very important. Keep in mind your favorite exam. This illustration 22 is quite important. In the exam, questions keep coming repeatedly from these two, just twisted around. Alright, with this, standard costing is finished. I hope you enjoyed it. I assume it was very beneficial for you, right? If you want to pay the fees, then the only fee is that you have to accept the exception, and the second fee is that students should be pushed by holding their ears and sent to SEC. Whether it is inter, final or foundation. All of them, just push them towards foundation, inter, and send them there. This is the only fee that you have to go there and nowhere else. Okay. Let's talk about uniform costing and interfirm comparison. You have been studying this since your intermediate classes. Sometimes, questions from this topic are asked in the exam. What kind of questions are asked? In theory, you may get a question on the prerequisites for installation of a uniform costing system. In uniform costing, we are not calculating the cost of a uniform. We are not working out the costing of cloth. It is basically a policy of costing which, if followed, will reveal the same cost accounting pattern in different companies within the same industry. Alright, so to apply this, there should be trust and cooperation among the companies in the industry. There should be a give and take mindset. There should be free exchange of ideas and methods. It is implied that bigger units share more ideas. There should be no hiding or withholding of information, and there should be no conflicts or disputes. Alright. In which areas can uniform costing be applied? This is to get an idea whether standards will be followed or margins will be considered. What should be excluded from the cost, how departments should be divided, how costs will be allocated to different departments, how administrative and selling overheads will be distributed, how WIP will be valued, cost points, and how defective, scrap, and wastage will be treated. All these things can be applied everywhere. Alright. Then you will read the points of advantages. You will read the points of limitations. What are the advantages? What are the benefits of this? The evil effects of competition and unnecessary expenses from competition will be reduced. It is also a tool for management control. It helps members to compare their own data with that of others. It avoids cutthroat competition and the process of pricing becomes easier. Alright, it enables the industry to submit to statutory bodies. In the future, you all can also go together to represent to the government. With this, cost audit can also be done properly and interfirm comparison is also possible. What are the limitations of uniform costing? You want to apply the same thing everywhere, but sometimes individual units differ, so it cannot be applied there. In smaller units, the cost of uniform costing will increase. Uniform costing can create conditions that are likely to develop monopolistic tendencies within the industry. Sometimes, everyone together even forms a cartel. If complete agreement between members is not forthcoming, the statistics cannot be relied upon. Many times, people just lie or make things up. What is interfirm comparison? If you do uniform costing and everyone's costing statements are similar, then perhaps you'll be able to compare your cost records with others as well. To understand what are the possible scopes of efficiency, deficiencies, cost, and profit, and where we can make improvements. What is the prerequisite for this? The prerequisite is that there should be uniform costing. The organization should also be structured according to responsibility centers. Collection of relevant information. Whatever information you are collecting for comparison, that information should be relevant. Related to things like cost, cost structure, labor and machine utilization, raw material consumption, waste, return on capital employed. If you collect and compare all this data, you will be able to understand things much better. This problem does not arise in such accounts. Since financial accounting is based on accounting standards and IFRS, there is already uniformity there, but this problem still exists in cost accounting. Alright, but even then, the role of cost accounting standards is to ensure that the cost accounting system of every company becomes the same. What are its benefits? The benefit of interfirm comparison is that you get to know about your strengths and weaknesses in relation to other industries. In this, we compare only significant items, so the management's time and effort will be saved. Management will be able to keep up-to-date information. Trends and ratios, this develops cost consciousness among the members of the industry. Keep these 4 points in mind, and if you find any other point relevant, you can note it down. If you write this once in your summary notes and read it again, you'll be able to remember the points. Right now, it might just sound familiar. Later, you'll have to remember it. What are the limitations of interfirm comparison of top management may not be convinced? Sometimes top management thinks no. Our firm is very different. Some firms do not disclose their data because costing information is internal information, so the data is simply not available. Many times, when we do better than others, we just stop there and don't want to improve further. If there is no proper cost accounting system, then you won't be able to use these figures. You won't be able to compare them relevantly. Alright. What is the way to overcome these difficulties? This is asked very often in exams. For this, you will have to run an educational campaign to explain to everyone what benefits can be gained by implementing the same cost accounting system. Then, the internal comparison system or cost accounting system you have should have accuracy, and it should also maintain secrecy. You also have to ensure that all the data does not get leaked, and it is better if there is a scientific cost system in place here. It is better if there is a scientific cost system here. Is it okay? So, the limitations of interfirm comparison can be overcome by using education, propaganda, and the installation of a secret system which will keep some information confidential. Meaning, the information should remain only among each other and should not be leaked anywhere else. We need to keep this in mind. And it should be scientific. That means there should be a bit of accuracy. Scientific means there should be a proper system. It's not like everything should run arbitrarily as per one's own wish. Scientific doesn't mean laboratory tests. It means there should be a proper system. Alright, so keep in mind these are the limitations of interfirm comparison. Top management is not convinced. There can be reluctance to disclose data and complacency may set in. If a proper cost accounting system is absent, then you cannot rely upon it. Alright, so what are the basic benefits? You will get to know the strengths and weaknesses. If significant items are reported, it will save time and effort. You will have up-to-date tracking. Cost consciousness will arise based on trends. Now, you will have to remember these points. Only then it will work, otherwise it won't happen without memorizing. You have to write down these points once in your rough summary notes and then revise them again. Alright, the concept is that if uniform costing comes first, then you will be able to do interfirm comparison. Uniform costing means doing certain accounting treatments in a similar way, which are related to cost accounting. There is a question on this. This has also been coming from the intermediate level. In this, they are asking to calculate the uniform price, which is basically the fair price. What is this called? It is called fair price. How will that be calculated? A simple method given here for fair price is to take the weighted average using the share of production. There are 4 firms here, A, B, C and D. The names are not written, but these are the 4 firms. The details are given, so just take the average of the fair price for all 4 firms. Or what is the second method? Take the weighted average of the cost that is given, as I have written here, plus take the weighted average of the return, that is, ROC, and add both together. The weighted average price you get will be called the uniform price. And what else needs to be done? Just calculate the weighted average fair price. Now, why is the answer coming from this fair price? Because the fair price that has been calculated here is not just made up. It has been calculated by adding these two together. That's why you can directly calculate the weighted average fair price as well. So, in the Institute solution, it has been done using cost and ROC. If you want to show it in a bigger way, you can do this forcefully, and since the answer has come from this as well, this might also come up sometimes. It can come in the objective section. Chances are less, but if it does come, it's very easy. You can do it comfortably. So with this, uniform costing is also completed. I hope you found this useful in costing. Now, if you don't do the MCQs, then this study will remain incomplete. Just like when you eat food and don't get papad with it, the meal feels incomplete. In the same way, you should understand that after studying so much, if you don't do the MCQs, then all your study remains incomplete. And you should not take MCQs for granted, thinking what are MCQs after all? We'll manage them. That won't happen. In the exam, you should set a target of scoring 28 out of 30 in the MCQs. We are giving the benefit of doubt for those 2 marks. The remaining 28 marks have to be scored, and you won't get those 28 marks like that. Unless you practice the MCQs 2 or 3 times, you won't be able to do them in the exam. Doing them once is not enough. After this, you have to solve the MCQs from the past papers as well. You also need to do the MCQs from the model test papers. You should dedicate an entire day just for MCQs, where from morning till evening you only practice MCQs, and remember in the exam you get 3 minutes for each MCQ. For 1 mark, actually, you get not 1 but 1.8 minutes. For 1 mark, you should be able to solve one MCQ in 3.6 minutes. You should keep this basic parameter in mind. You can use 3.6 minutes for one MCQ. But try to solve them a bit faster so that you can save some time for your main sums. Alright, and apart from this, I have already told you a bit about the theory as well. Apart from this, there are some theory chapters that you will also have to study because sometimes in the exam, 1 or 2 questions from theory are placed in such a way that even if you know part A very well, if part B is theory, you are unable to attempt it. Or sometimes MCQs also come from theory, so you should have knowledge of theory. For that, there is a separate theory video. All the theory is discussed in that. It will explain everything to you, but you will have to sit and memorize the points yourself. So, you will have to devote a day for theory as well, so that you can understand everything thoroughly today. Today, you will also memorize everything completely, and if you need to make any short points or notes, you can make them as well. So, MCQs require 1 day, theory requires 1 day, and this is applicable for every subject. Alright, with this, all the discussion related to casting is now complete. Alright, thank you so much.